All right, good morning, everybody. Good morning. Let me ask you a question. Have you ever wondered what it actually takes in the markets to be successful, really? And not just surface talk and learning the indicator or learning price or learning actually how to do it. I'm talking about actually what it takes, right? The reason why I'm asking that question is because I was having a dialogue with some people this weekend, and we were talking about why people make it or don't make it in the trading space and why there's so many failures in the trading space. This is the number one reason. You have to become mentally adjusted to what the markets give and or don't give, because your mentality about trading and wanting to make money versus the actual what it takes to make money are probably two very, very different things. Um, I didn't even say this to my guys. This is my guys are here with me today, um, and this was a surprise. This is our first day on the journey to $1 million. We've been tweaking and moving and trying to put some things in place for everybody, and we have a team of 5 people, right? We have 3 traders and we have 2 mentees, okay, and everybody's on the same journey to that million, that million. So with that said, right, I'm going to go through the charts. But before I go through the charts, I want to also explain something. On Friday, um, people saw me trade live and they saw me switch accounts and go from here, go from there, whatever the case is. But you have to realize that we have, like I said, we have a team of 5 and 3 traders, and we trade 3 different accounts. And when we trade 3 different accounts, if one person, and it was me on Friday, has 3 losers, what we do is we stop trading on that particular account, go to Sam, and then we still call the trades for everybody else that's on the team, right? That is how you make it overall. You have to have a team, okay? And that is how we do what we do. Um, and just because you have losses, it's part of the business. Anybody that tells you they win all the time is blowing smoke, and you should run. I'm not saying that you won't have 20, 30, 40, 50 winners in a row. I won't say you won't win for a whole year and a half in a row, but there are going to be some losers at some point because it is just the way the business is. And what we do is we manage money, we manage risk. That is what we do. Okay. And what I tell my guys is the number one rule in this business is capital preservation. You preserve capital, you build capital. And we're going to go on that journey to do just that. So let's get into it with the quarterly. I hope that answers some questions that I got over the weekend. But you're more than welcome. Shoot me an email at support@theprofitstalker.com. Please like, subscribe, share, because we're real people doing real things over here. All right. But anyway, so quarterly, as you can see, it's getting toward the top, toward those all-time highs. As I told you before, you didn't know which way it was going to go because it was inside. Now I'm pretty sure it's going to break the all-time highs, but we'll see. Right. Um, Again, it's still an ABC pattern until she breaks the all-time highs. Uh, but I've got a good feeling that she's headed that way. On the weekly uptrend, as I told y'all many, many weeks ago, came down here and hit the support zone. When she got in the support zone, she bounced up off of it. And on the daily, you can see she's at the top of the resistance zone. So this is going to be an interesting task whether or not it can get through here, right? So that's that there. And let's go ahead and get to our intraday charts. And we'll wait on our opportunities. We'll wait on our opportunities. There's nothing going on right now. Can someone please pull up the news and let us know what news we're going to have? Ronald's going to be out today. Today we do have Keith, myself, and Quentin on. Carmen and Ronald are out today.
There is no news today. Well, you have a 10 o'clock yellow folder for CB leading the index.
Okay. All right, cool. Yeah, that ain't about nothing. All right, cool. So what we do is we just wait. All right. We just wait.
How to turn 5 million and how to turn 5,000 into a million is ready if we want to play it.
Yes, please do. Please do. And then we'll go on mute. There's nothing to do right now because we don't have any trades, ladies and gentlemen.
Got a short coming up on. Oh, you look. Which chart are you looking to trade on?
I'm looking to trade live. You do what you do, Keith. You do what you do. If you have some questions, shoot me a text or say it in the group. I've said in the group. I don't care which one. I wouldn't. Let me tell you something. I wouldn't take this short on the 2700 because you had those two bars to close above those MAs as a kind of as a rule for me, right? Which means that it may go down, it may not. So I'm going to wait. I would wait for everything to be aligned perfectly. It's not just yet, and you see it's pushing up. And ladies and gentlemen, on the 8100, you have what you have potentially call a head and shoulders pattern. I won't get into all that, but it's interesting to see how this thing is going to play out. But I'll go on mute, and we are here, and you can cue it up, Q.
Okay.
Millionaire on the stock market. Without a doubt, every trader is interested in the question of how to trade a small account up. How do you manage to increase this, usually small, seed capital? Or better still, how do you manage to make a small fortune out of this small sum? Preferably, as fast as possible. As soon as the money is in the brokerage account, most traders usually start looking for some kind of holy grail method, which sometimes takes years, as long as there is still money left. I would like to point out my views of things in this book. It will probably surprise some, and will certainly upset others, because what I have to say on the subject may not suit everyone. Those who have read my other books know that I am critical of the idea of making a fortune out of a small capital investment. Yes, there are traders who succeeded in doing this, but they are few and far between. And above all, there are very few who have done so with the traditional short-term methods. The goal of USD 1 million is a very high goal for most traders. In fact, some would say that 1 million is the sum you should bring with you when you go to the stock market. As the reader, you possibly know that even this kind of money is no guarantee that you will be successful. Most traders do not have so much capital when they start anyway. So the question is quite legitimate. Once you have made the decision that the stock market is the best way, I know someone who made his first million selling ice cream. What do you need to do if you want to earn $1 million? Big goals need big perspectives. If you plan to earn USD 500 with trading, then you need a different perspective than if your goal is USD 1 million. This book is about how to adopt such a perspective. Unfortunately, many traders try to reach this goal by sticking to the USD 500 perspective. I just need to reach this modest goal for enough days in a row, they say. Then I'll get to the million on my own, sooner or later. As a rule, these traders never reach their goal, and I firmly believe that the reason for this failure lies in their incorrect perspective. It is like looking for 5-cent pieces on the street. No doubt, you could become a millionaire by collecting 5-cent pieces. But in my opinion, that would take much too long. Incidentally, I only came to understand this simple truth gradually. I was one of those traders who looked for 5 cents every day. The tragedy of this approach is that every now and then, you actually will find a few 5-cent pieces. That little surge of happiness that one feels makes one think one is on the right track. No doubt, the person who collects 5-cent pieces will reach his million one day. For example, if he finds one of those coins every day, he simply needs to repeat the success for the next 20 million days. I think the reader will see the absurdity of this idea. So, if you set yourself a high goal, you should look for ideas that will get you to your destination a little faster than our brave collector of 5-cent pieces. In this book, we will look at how one can find such opportunities and what perspective we need to adopt, rather than walking around with our eyes glued to the sidewalk. I would like to present the reader with a strategy that, in my opinion, makes it possible to make a fortune on the stock market. I am not saying that this is the only way, because there are thousands of ways to make money on the stock market. But it is a radical method, because it assumes that, under normal circumstances, the trader with a small starting capital will not be able to achieve this. Nevertheless, the possibility exists to make a fortune on the stock market with just a small investment, by procuring the missing capital from another source outside of yourself. The strategy that I present here starts with the assumption that the trader cannot achieve this with his money, but only with the market's money. He will have to learn to get the money from where it is, and he'll have to do it with chutzpah. In other words, he will have to take some serious risks. I think that speaks for itself. To say anything else would be a lie. Just as it is possible to build a real estate empire without $1 of equity, so it is possible to build a large trading account within a relatively short time with a small starting capital, USD 5,000, or even less. I am contradicting myself here because I have already said in previous books that this is not possible. What I meant was that it is not possible to do so with conventional trading methods. In other words, you will have to go to very unconventional ways if you want to achieve that goal. Chapter 2. Trade with the market's money, not with your own. My best year of trading was 2008, but most of the money I got did not come from my day trading or scalping. Although those methods also worked well that year, most of my profits came from a single trade. A single. I earned more with that trade than I had in the previous 3 years. This experience was a kind of breakthrough for me. These are the kinds of moments when you discover completely new possibilities. That was the case with the one trade with which I made a 6-figure sum. It was the time of the financial crisis. Lehman Brothers was broke. The stock markets had plummeted. Almost everyone was sitting on big losses, while I was able to reap the biggest profit of my trader career because I was standing on the other side. No, I was not short in stocks, even though that would have been an excellent idea. I was long in silver. That was my only position at that exciting time. Long silver. I was convinced that in a crisis of confidence of this magnitude, subprime crisis, it would be a good idea to buy so-called crisis currency. Investors like to park their money in markets that are considered safe havens in times of turmoil. Traditionally, these are the precious metals,
pause a sec.
especially gold and silver, of course.
I'm looking at the 8100 just to get some insight. I'm trying to confirm the resistance and support levels because it looked like it was sideways for a second there, for a little while. So I got a support around 59.25. I mean, I got a resistance around 59.25 and a support around 518.
Boy, you spot on, man. Because that right there is where price hit just about every bar going across, right? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 bars and about 20 bars. So about half the time it's been hitting that 60 and a quarter price. And on the bottom level, it's hit that what I call that 16, the 18 and a quarter area. 1, 2, 3, 4, 5, 6. Coming on about 6 times out of 20. She's been trying to go up more than she's been trying to go down, but that means that it might be trying to turn over here. So you're right. You're right. So let's just see what happens here. Let's just see what happens.
You can start by playing again. Because it look like
All right, 10-4.
I think we're gonna have. I thought we might be getting to get something, but it's moving kind of slow.
All right, 10-4.
But also currencies of certain countries, such as the Swiss franc or the Norwegian krone. At the time, I did not understand that this also included the US dollar. Escaping the risk usually helps the markets that are considered relatively stable or low risk. I chose silver because I assumed silver would outperform gold in this crisis. This assumption turned out to be correct, but unfortunately, it did not really materialize until 3 years later, when silver climbed to stratospheric heights in the wake of the euro crisis. Still, my silver trade of 2008 was a success, though the movement on silver in early 2008 was modest compared to what had happened in 2010, 2011. I started building smaller positions in the range of around USD 13 or USD 14. During the subprime crisis in late 2017, these first positions turned to profits quickly and easily. After a few days, I already had a book profit of over USD 1,000. Not bad, you might think. And under normal circumstances, I would have been happy with that gain, and I would have sold the position. Incidentally, I did not intend to keep that trade going for long. I gladly admit that the trade was intended as a day trade. Once the position had gained nicely, I thought, why not keep it going a little longer and try to get more out of the trade? And indeed, silver rose the next day, and I had the courage to buy another contract. But you have to be aware of the hysteria of those days. The media was full of bad news, not to say catastrophic news. The stock markets plummeted worldwide. And when the news of the Lehman Brothers bankruptcy on the ticker came on September 15th, the dam broke. The crisis was complete. My silver trade, on the other hand, did very well. The more the silver price rose, the more contracts.
You had a quick trade on the 900. I was looking at the 2700 though, so I didn't see it. But you had a pullback there. It would have been like for 8 points, and it went right at 8. So you had to take your money quickly if you wanted to highlight.
So, full disclosure, I took that trade, but it was let me see what I'm talking about. I took that trade, full disclosure, but hold on, study. Let me see here. I took that trade and made 5.5 points on it, but it happened so fast. I mean, it happened fast because the thing, you see how it dropped and it just kept going. Like when it closed, it kept going to the downside. I wasn't really looking. I'm not looking to really call any trades for the group as long as it's in this range, because you could get slipped. Like if I call the trade for you and you don't take the profit quickly, you see how that thing snapped up like that? It just took off to the upside. So it wasn't a huge winning trade at all. I was kind of upset because it gave you this bullish engulfing bar. Then it gave you an inside bar and then broke the low. That's what a trade happened at, really. Because you could see that the movement was down, right? Trend was down, momentum was down on your larger time frames. And that's where the entry was, but it wasn't a market structure pullback. So we just wait. Now you have a bullish engulfing bar on the 8100. So you got to see if it's going to do the same thing, which is potentially give you an inside bar and then break the low of the bar. It's going to continue down for a bit. So that's that. We can queue it back up, Q. We looking for it.
Days later, I already had 5-digit profits. But if you are now thinking that such a profit would lift you to a permanent state of elation, you are mistaken. Prices do not go straight up. I wish they would. Not at all. When markets go wild and volatility picks up, prices fluctuate so much that they can go just as widely the other direction. I remember that my silver position was USD 17,000 in profits one morning, and only USD 12,000 in the afternoon, due to a correction. A book loss of USD 5,000 in just a couple of hours. That was much more than I would allow myself under normal conditions. But you have to be able to live with that if you want to increase your position systematically. Let me point out that I did not have a smartphone at the time. I'm a bit old-fashioned. Having a number of contracts in a trend market is a disconcerting thing. Actually, great success is also somewhat disconcerting, which is why most people prefer to live without it. So, I had to open my laptop every time to see what was happening to my silver position. At the beginning of January 2008, silver struck a resistance of about USD 15. This resistance had lasted for 2 years. I had placed several stop-buy orders above this level, all of which were executed when the outbreak came. Soon, I had doubled my position again. Now it became really exciting. The fluctuations in my account were now quite wild. Within a minute, I was several $100s richer or poorer, and soon it was to be thousands of dollars. See Image 1, Silver Monthly Chart, 2006 through 2019. I remember well that I felt I was on the safe side with this position. I knew that I had a winner, and that all I had to do was rigorously trade the upward movement in silver. This was an extraordinary situation, because I had only a few thousand euros in my brokerage account. I used it to experiment and perform occasional swing trades if I saw an opportunity. If I remember correctly, I had about 2,700 euros in that account. Not much, considering that thanks to this one silver trade, I eventually had a book profit of more than 40,000 euros. So within a few weeks, I had made more than 1,000% profit, thanks to the leverage I used and the fact that I traded with the money that was on the market. That was the whole secret of this trade. I did not trade with my own money. I traded with the market's money. I suggest that we take a closer look at this, because some readers might not understand what I'm saying. If you buy a property and finance 70% of it, you are basically not buying this object with your money, but with the bank's money. The bank pays for the major part of this property because it considers the property as collateral, and the house remains the property of the bank until the last installment has been paid. Something similar happens in the stock market. Once you have book profits, as long as you do not realize these book profits, you do not sell your position. That money does not belong to you, but to the broker. However, this book profit allows you to buy additional contracts. because they will be credited to you through the daily settlement. So, this book profit allows you to buy a larger position than you would have normally been able to buy with your small capital. This is a comparable leverage, as if you were buying a property with a loan from the bank. And of course, you cannot call your accumulated book profit your own until you sell your position and earn the profit. But as long as you do not sell, you can continue to buy provided you are still right in terms of the market direction, and the trend continues to grow in your favor. This approach is very different from closing your position every day and reopening it the next morning, which is what a day trader does, for example. At first, day trading seems less risky, but it is easy to forget that every day, the trader carries the whole of the risk. He risks his money every day. His own capital is fully at risk. However, if you do as I did on the silver market in 2008, at some point, you will no longer be risking your own money. You will begin to speculate with the market's money, thanks to your book profits. Technically, you may not see the difference, but in terms of risk management, the difference is huge. As soon as your first purchased contracts run into profit and your book profit increases, you have a free trade, so to speak. From that moment on, you can use your book profits to expand your position. So you do not buy with your own money, but the market's money, or with the bank's money, if you will. Moreover, I think that you should not keep the leverage on your position too small when you find yourself in this comfortable situation. Quite the contrary. From now on, you should really grab the ball and expand your position seriously, because that is the only way you can make real financial progress. The same is true for the clever real estate investor. He does not buy his properties with his own money. He buys them with the bank's money. And the more properties he owns, the more he buys. It is a proven concept. If you research a little, you'll find that apart from those who have built a successful business, most rich people have become wealthy with real estate. Over the course of January and February of that year, silver rose to over USD 20. While it was on its way to the top, I bought more contracts. In the end, not as aggressively as in the beginning, because after studying the chart, I had the feeling that at some point, silver was going to reach a peak, and then the inevitable correction would occur. This feeling was soon to come true. In March, silver reached its high. The volatility was almost insane. I started selling my contracts and locking in on my profits. In hindsight, I sold a bit too late and lost out on some of the profit I could have made. But in hindsight, you are always smarter. The trade was a big success, and I was able to live on that kind of money for a long time. After I had closed the position completely, I did not do anything for months. It took time for me to recover from my own success. Anyone who believes that success is something great and simple is wrong. It is really scary, because you are confronted with something that is unknown in you, something that is much bigger and more powerful than you. Chapter 3. Learning from the Grand Master of Speculators. In stumbling into this trade by chance, I unconsciously did something that would only become a real method in years to come. Of course, I knew what I was doing. I had heard of other traders who had completed these types of trades successfully. And of course, there are examples of traders in trading literature who have become wealthy in this way. But let's be honest, you can only really understand a method if you apply it yourself. Theoretical knowledge does not help you at all. Since I did not intend to do such a trade, I was not prepared for the potential risks of this method. Neither did I know what I would go through emotionally during the time I was holding that position. In retrospect, I took time to study the traders who had used this strategy successfully, and above all, of course, the American trader and speculator Jesse Livermore. He is probably the most prominent example of a trader who went the whole hog. You can read about Jesse Livermore on the internet. And of course, I also recommend the book by Edwin Lefebvre, Reminiscences of a Stock Operator. It describes the method we are talking about here in an entertaining way. Of course, Livermore did not master his method from the beginning. He started off playing the market in the short term, like most of us. times do not change. At some point, he realized that the big money could only be earned with the big market movements. Of course, for this, he needed a different method to that of a day trader. First, one has to say that Livermore traded primarily in equities. There was no such thing as trading with an index at the time. However, you can apply this method perfectly in the usual trading markets, such as SP 500, NASDAQ, DAX, IBEX, CAC 40, or Euro US dollar. Before Livermore became active at all, he observed the markets. This is the first pillar of this method. Livermore was a good observer. Above all, he looked at the market leaders of that time, the driving forces of the stock markets. He studied the most important stocks of the
Can we
sectors.
pause it for a second? Everybody, there have not been any trades called for the live YouTube. I have taken one kind of a ultra scalp trade. The reason being that I took the scalp trade is, let me show you that first. I had a small setup right here for me, and I knew it wouldn't go far because all it was a correction on a larger time frame, and it came down here and hit a level of support right up in there. So I knew that, okay, if it hits that level and keeps and doesn't just push through it, then you might as well get out of that trade, which is what I did. All right. So, and you can see here, if I put show order fields here, you can see where I got into the trade here and then got down to this key level, and I wasn't going to take a chance there. So you can see where I got in and got out of the trade. I got in at 350 and got out at 98, which is nothing to write home about, but it's a good commission cushion is what I call it. So it's not in, like I said, not anything serious. We're looking for trades that we can add on to. Haven't seen that today. Haven't seen that today at all. So we're in a consolidation hold pattern, and you can see it right here. Keith mentioned it earlier, where we have support and resistance. I don't have the lines drawn today, but you can see where it's just really in a tight range. So we just have to wait for an opportunity after that. Are there any questions for me from the fellas?
No, I did notice the consolidation on the 8100, and the 2700 really following suit. So we just have to wait.
Exactly right. Exactly right. All right. Well, we would do just that, and we can queue it back up.
For example, Bethlehem Steel or Northern Pacific. Of course, today those would be stocks like Apple, Google, Amazon, or Facebook. He watched the behavior of those leaders. He looked at how they responded to certain news, whether they recovered quickly from a negative news announcement, bullish, or not, bearish. If you want to get involved with Livermore's method, you can refer to the little book by Richard D. Wyckoff, Jesse Livermore's Methods of Trading in Stocks. In my opinion, the key word here is observing. In other words, Livermore may have had no position in the market for weeks or even months. He was 100% in cash during those periods. That is not easy for many traders, because you have the feeling that if you have no position at all, you are not involved in the stock market, and you could miss out on good opportunities. Nothing could be farther from the truth. 100% cash is a position. Actually, it is a very important position. Before you can act, you first have to learn to observe closely and wait for the really good opportunities to come your way. Patience is one of the most important virtues that you will need to develop if you want to be successful with this method. It is undoubtedly the hardest part of the method. You will have to learn to transfer money to a brokerage account and then do nothing for weeks, sometimes even for months. Can you do this, even if your broker bombards you with emails and asks you to start trading because his systems are sending him great signals? Again, you will have to learn from Livermore, who hated nothing more than the so-called tips that you get from everywhere as soon as you enter the stock market. He tried to free himself from these confusing influences by all the means he had at his disposal. He did this by partially isolating himself from the outside world, so that he was only able to listen to his own intuition and instincts. He did not become active until he saw a real opportunity, coming from his own observations. I think that this habit is much more difficult to learn today than it was in Livermore's day. Today, the news, opinions and tips, and whatever distractions the broker industry may invent, do not only come in the form of newspapers, magazines, newsletters, emails, and alerts. They also flash at you at the most inopportune moments, on the small, flat device that each of us carries around permanently, wherever we go. You must learn to forget about all that noise and disregard all the supposedly interesting stock market pages and the seemingly interesting articles by analysts. Or even better, do not even read them anymore. You must learn to become a completely independent observer and a completely independent-minded person. If you have acquired this important capacity of being able to ignore what others are saying, you will one day begin to perceive the signals from the market yourself. This is very important, because you cannot trade this method if you cannot observe and think on your own, and have therefore not formed your own opinion of the market. Did I just say that you don't have your own opinion of the market? Yes. Even though you may have read everywhere that you can only be a good trader if you have no opinion of the market. This may apply to short-term strategies such as day trading, but it does not apply if you want to make a trade, as I did with silver in 2008. At the end of 2007, due to the financial crisis, I was bullish on gold and silver, and the market proved me right. Will you always be right regarding the direction of the market? By no means. You will experience again and again that you have to close your first position at a loss, or that your position does not progress at all. You will experience that the market does not confirm your opinion. There's nothing wrong with that. That's part of the game. Hopefully you will get out of it with a small loss and return to the observation status for weeks or even months. After all, you want to respect the first law of a trader. Preserve your trading capital. Second, you always have to maintain another, even more important asset. And I do not mean the amount of money in your own account. Your most important asset is your ability to think and observe independently. As long as you have a position and your money is exposed to market risks, you cannot think anymore. You are emotionally involved with the trade, and the bigger the position becomes, and the more money there is in the game, the more you will battle with your feelings and emotions. If your emotions are so strong that you can hardly bear it, then your position is probably too big. If your emotions are so weak that you hardly feel them, then it is probably too small, and you should add to your position. It goes both ways. For example, I was one who tended to keep my positions too small. Therefore, my silver trade was a sort of cathartic moment for me, because it forced me to give it a go when the opportunity presented itself. One has to realize that making money on the stock market does not happen in the same way as it does in the usual professions. With a regular job, you get the same amount each month. That gives those who walk this path a sense of security. There is no such thing on the stock market. Oh well, some think that it is possible. Day trading, for example, is an attempt to reintroduce the security of an office job, with regular income coming through the back door. On the stock market, there are only asymmetric earnings. What does that mean? Mostly, you do not earn anything, or you can even lose a bit. And then comes the day when the roast is served. These are the occasional opportunities where you can make a small fortune. Needless to say, these opportunities are only available to the trader who is prepared. And that is why it is so important to build your own independent observation post, as Jesse Livermore did. Then, if you see an opportunity based on your observations, you should buy, or sell if you go short, a small first position. This first position is to test the water. But the first position also has another important function. According to Livermore, you cannot judge a market until you are in it yourself. This first little position tells you whether or not you are in the right market. If you do not have a position, there is no way of knowing. You have to be emotionally involved with your own money. If the trade feels good and the market is moving in the right direction, you can start buying more contracts or more shares if you trade in stocks. Of course, you will not catch a major trend every time, as I did with my silver trade. Sometimes you will have to interrupt the trade because the trend does not continue or even turns in the other direction. But if you follow the criteria that I will explain in the following chapters, you will occasionally make a nice profit. Chapter 4, Scaling In, Scaling Out. The real secret of a successful trading business is not the perfect entry or the perfect exit from a position. Too many traders put too much emphasis on this aspect of strategy. The real secret is ensuring that your winners are infinitely bigger than your losers. If you have a book profit with a trade, you should not frantically sell and pocket the profits, as many traders do. You should see this book gain as an opportunity or an option. You should ask yourself whether or not there is still a lot to gain here. So, the right strategy is to invest in this book profit. In principle, this trading technique can be carried out with any financial instrument. Of course, you will benefit most if you build such positions with leveraged instruments, such as features or options.
Fellas, can we go on?
Reinvest your unrealized gains on open trade.
So I've scalped 2 trades today, but I've had not seen anything I can add to because again, we're in a range. The only ones I'm calling live for YouTube are the ones that we can add on to potentially. That doesn't mean we're going to add, it just means we have a higher potential to add. And it's at the bottom of the range right now. So I would steer clear. Unless you're an experienced and very, very nimble trader, there's nothing to do here. There's literally nothing to do. It is going down. You give us a nice little trade right here, but again, it's still in the range. So just kind of letting you guys know where I am, where I stand, and why I stand where I do. If anybody has any questions or comments, please let me know. I do see red and red. It's just that this thing happened. This is the first, second, this will be the third move. And now that it's out of consolidation, what we want to do is see this 8100 go back up into resistance and then fail and then come back down. So if you didn't take this trade in consolidation, there's nothing to do. All right.
Which chart were you looking at for that trade?
I was talking about the trade that I had.
Oh, I thought you said you said first, second, third move. You're looking at 900.
Yeah, the 900. This was the first move, the one that I took for a scalp, 5 points again.
Mm-hmm.
Then you had the second move here that I did not call or take. This one right here. And then, as you can see, now that everything's out of consolidation, now it's going to work. I mean, now you might have another legit opportunity, but it will be the third move, which we don't take. So what we want to do is see the market now go back up, test that area, fail, and then come back down. So that's what we're waiting on now. This move looks nice, but remember, you had to take it in consolidation, hoping and praying that it would come out of consolidation. She made a higher high, a lower low, a lower high, a higher low, a lower high, now a lower low here. So she hasn't been in a trend on your larger time frames today. So that being said, we chill for a minute. Any questions for me? Keith, Quentin?
Mm.
No, not really. Not really. Just a comment.
Okay.
I'm just how many contracts are completing, and how fast the volatility or how fast price is moving, because like you said, it's come out of that consolidation. So I will be looking closely to see what happens next. So I would just say to the audience, pay close attention to what's happening next.
Cool, cool. All right, man. Well, we'll queue it back up and we'll come in when there's, something to talk about or more opportunity.
Trades. Put simply, you only buy additional contracts or stocks when the previous ones are already in profit. In this way, you can build up large positions in a market without increasing the initial risk of the position. The RRR, risk-reward ratio, will gradually improve in this way. However, if you do the opposite, averaging down, you increase your risk. Averaging down when prices fall further only makes sense for long-term oriented investors who, for example, have a dividend strategy. Right from the beginning, I would like to make it clear that the technique of buying up is easy to understand, but it is not necessarily easy to carry out. This technique goes against the nature of the trader. As soon as a trade becomes profitable, the trader wants to hedge it through active stop management or even pocket the gains. The trader must therefore muster a good deal of self-control and discipline in order not to concede to his natural tendency to take the first profits and run. On the contrary, instead of taking the profits and getting out of the market, he has to learn to buy additional contracts or shares. He has to learn to increase his position when the starting position is in profit. This requires courage, but also the insight to understand that this is the only way to reach substantial profits. The method that I present here is not the same as so-called pyramiding. It is important to clearly describe the difference. Building a pyramid in a market means that the first position you buy is the largest, the base of the pyramid. Each additional position you buy should be a bit smaller than the previous one, usually half the size. So, if you start with 100 shares, then the second position should only be 50 shares, the third, 25, and so on. The idea of this approach is clear. A trader who works with this methodology believes that the longer a trend lasts, the bigger the likelihood is that it will turn. That's why he reduces the risk. Although I can understand the logic of this methodology, it is a suboptimal idea for me. If you are right about your market assessment and the trend continues, then you should definitely go for it. Because if you are already sitting on good profits, you can, as already mentioned, speculate with the market's money. You should internalize this difference. Risk is not equal to risk. If you are a day trader and close your positions every night, you start afresh every morning. This means that you risk your money every day. In that sense, one could say that day trading is suboptimal in terms of risk management. Every day, you risk your money in the markets. By contrast, if you scale into a trend, you only risk your money with the first position. For the second contract, you pay with the market's money, with the book profits from the first position. Therefore, I am not talking about pyramiding, but about scaling in, scaling out. Unlike building a pyramid, you cannot increase your position until the first position has enough book profit, so that this book profit gain enables you to buy a second position. This second position is not smaller than the first. It is usually the same size. For example, if you trade futures, the smallest unit is one contract. You cannot reduce or divide this unit. In that sense, you double your position with the purchase of a second contract. If this one also runs into profit, the book profits of the first two contracts allow you to buy a third contract. From now on, you do not double your position, as you did with the second contract. Your position increases by 33%. The longer the trend lasts, and the more contracts you can buy, the smaller your risk will be, even though you substantially increase your position with each new purchase. Thus, with each new contract you buy, you greatly increase the chance of a huge win, while minimizing your risk, thanks to accumulated book profits. Therefore, in my view, scaling in, scaling out is a much less risky method than day trading, or even holding a stock portfolio that you have bought with 100% of your own funds. I hope the difference is clear. An intelligent investor tries to generate a maximum return with the lowest possible initial risk. This is the case with real estate. Here, the bank finances your property, and your tenant pays the installments. And this is how it should be when you buy a company company shares through private placements, not by buying shares in the market. In my opinion, the method of scaling in, scaling out, therefore belongs in an advanced investor's toolbox. The first position is nothing more than a hypothesis, and this is really how you should see it. You make an assumption as to how a market might develop from the moment of purchase or sale on a short sale. This assumption is either confirmed or not. Basically, the output does not matter. Sometimes you'll be right, sometimes wrong. That's why you should not pyramid, buy the largest position at the beginning, because you then buy the biggest position with your money. It is better to buy the larger portions of the position with the market's money, through book profits. Of course, the scaling in, scaling out method is not completely risk-free, because a medium or small reversal can reduce or even destroy the accrued book profit. Needless to say, if this happens, you should start to reduce your position and close it completely if necessary. Then it is a case of nothing ventured, nothing gained. Ideally, you should build a position in such a market so that this never happens. That's why I recommend that you do not use this method on medium trends, which take a few days, or even on short-term trends, a few hours. That's the common mistake many make. This method is designed for the major stock market trends. The idea is that you are in the trade for a matter of weeks and possibly several months. Only in this way, you can achieve above average profits, even with a small starting capital. This is hardly possible with the trends that only last a few days. The position takes time to develop. For example, if you buy a stock at USD 20, your goal should not be to sell it at USD 22. That's not a big trend. But if you hold on to the stock for 6 months and it rises to USD 35, then you have the time to build a significant position with it, which you finance with book profits. Scaling in, scaling out is not unusual, by the way. It is a common method used by many traders and also hedge funds to build significant positions in a market. However, if you have no previous experience with this method, I recommend that you start with a calm approach and do not buy too many contracts on the first trade. I will demonstrate how the technique works with 2 examples. See image 2, crude oil, scaling in, scaling out. As an example, let us have a closer look at this short trade in the crude oil futures. After the market gave a bearish signal, the trader went short with a first futures contract at USD 69.70, small red line in the upper left corner of the chart. As the market continued to fall, he sold at USD 66.4, a second contract short. Overall, he sold 7 contracts in this falling market. When crude oil hit the USD 50 mark in late November 2018, the future started to go sideways at that level. After not falling any further for a week, the trader was aware that a reversal or correction could happen and started scaling out. He bought back a first contract on the market, first green arrow on the bottom left. Thus, he was only 6 contracts short and had realized the profit of 1 contract. When the market stabilized above USD 50 after 3 days, he closed a second contract and a third contract 2 days later, so that he was only 4 contracts short.
Here's ABC
Trader
pattern
was
on the
rewarded for his
2700.
patience, because on December 17th,
It is, but I'm not seeing on the 8100. I'm not seeing it. It hasn't pushed back up to retest yet. But you're right. Yeah, you're right.
Absolutely. And this thing right here is it stopped out at the initial lower high on the 2700, and now it's starting to fall back down. It's giving you a, if I'm not mistaken, that's an inside bar market structure. Hold on, high 87.75. No, that's a market structure completely. So you have a high of 87.75. You have a high of 88.25. And then you have a high of 90.50. So it is a market structure to then turn back over and come back down, but we need to wait and see if it's going to come back down here. If it breaks below, I'm telling you now though, just as a full disclosure, I'm not going to call this trade, but for longer term traders, if this thing breaks below 71.50 before it breaks above 91, before it breaks above 90.50, if it breaks below 71.50 before it breaks up above 91.50, it's a long-term short. The first short was a stop out if you got out of it.
First one was oh yeah, your charts are different.
Huh?
I said the first one I took was first short. It was a 30-point stop, but
It
it was
was a 30.
based
It
on
was
my
a 30
charts.
point stop.
Yeah, it's not on what you're looking at though. It would have got you out at 79 if you waited for everything, waited for the S. But that's using the Hikinachi's.
I got you.
So it's completely different from what you're looking at. That's throwing me off for a second. But wouldn't your entry be right there? Off the red bar break?
Yeah, you'd be in it now. You would be in it now if you're going to take this trade. This is a more likable trade. But it's tough.
Yeah, I didn't get in it. When you said you're being in it now, it was too late. But then it's stuttering right there. So I was thinking about getting into it, but I don't like the way it's playing right there.
Yeah, it ain't playing out.
It's been trying to go up for a second, like, so I'm just like, yeah, because you already had a pretty good move down, so it could be the bottom of it. Let me see, I'm looking
Right, and the thing is, we really waiting on this thing to come back up, and it literally got back up to that resistance at 92, close to it.
Mm-hmm.
Yeah,
I see the second resistance starting right there.
So it literally, I mean, it's just right there. It's right there. See, this is the thing I tell. So everybody, I'll tell you, here's a nugget. When you're trading, you have to, and when I say have to, you have to understand exactly what you're looking at, long term, short term, intermediate term. You have to know exactly what you're looking at, so that when you do get an opportunity, you know exactly why the opportunity may or may not work and why you want to have it or don't want to have it. This right here is interesting though. This is interesting. You got 6,000 bars. I wouldn't be doing anything for 6,000 contracts. And the reason why is because I want to see how this bar completes, unless it got below that 65 area. And I'll tell you exactly. 64 and a quarter. If it gets below 64 and a quarter, it's probably, it's about to fall apart. It's going to go down. I'm telling you that now. And I say that, and we just watch it. I don't have a trade, but once I get a trade, I'll be looking at that opportunity. So we just got to wait on it now. We can go back to playing. We can go back to playing how to turn $5,000 into $1 million.
10-4.
Crude oil after 3 days. He closed a second contract and a third contract 2 days later, so that he was only 4 contracts short. The trader was rewarded for his patience, because on December 17th, crude oil fell below USD 50. When the futures fell below USD 47 the day after, he closed a fourth contract. Now he was only 3 contracts short. The low of this move was USD 42.72. Of course, the trader could not predict this low, as the future began to rise again in the following days, he gradually closed the 3 remaining contracts, green arrows on the right. Although the trader did not reach the optimum in this example, he nevertheless made a successful trade. He was in this move with 7 contracts short, all of which he was able to close at a profit. Overall, the trader was in the position from October 18th, 2018 to January 2nd, 2019, almost 2.5 months. This is a typical time frame for the type of position trade we are talking about here. Therefore, we are going to take a closer look at the trade and the development of the individual contracts. In this case, the trader traded the crude oil futures contract at the CME, code CL. The tick size, smallest price fluctuation, is USD 0.01 per barrel. The value of a tick is USD 10. The overnight margin of his American broker was USD 2,145. This means that the trader needed to have at least USD 2,145 in the account in order to trade a contract. However, he was able to go short with future contracts, thanks to the book profit of the first contracts. Contract 1. Short, USD 69.7. Flat, USD 53.5, P6.4. Contract 3, USD 12,100 times USD 10. 1,380 ticks. Profit, 47.5 equals USD 84,000. I hope I could demonstrate the advantage of the scaling in method in this example, where a profit of USD 84,150 was recorded. In other words, the trader was able to realize a profit of USD 84,150 with a bet of USD 2,140, initial margin of the first contract. These are the trades I'm talking about, and they really help to grow your account substantially, and in many cases, your financial position too. That's why, in my opinion, it's worth waiting patiently for such opportunities. This example is a bit idealistic. Here, we were dealing with a market that was gradually going down, like a flight of stairs. Of course, this situation makes it easy for a trader to build a position step by step. He was also able to quietly scale out when the market reached USD 50 level. Normally, you would expect a proper reversal here, which forces the trader to close his positions quickly. Since this was not the case, the trader could benefit from another fall in the price of oil with the 4 remaining contracts. It should be clear to the reader that such an ideal case does not always occur. As a rule, if we are dealing with a real crisis market, things are a bit more chaotic. The next example illustrates such a situation. See image 3, natural gas future, 4-hour chart. In the example in image 3, the trader chose to trade the main contract on natural gas, NG, which is traded on the NYMEX. His American broker required an overnight margin of USD 2,420 per contract. If he had traded with a European broker, for example, he would have had to deposit USD 5,000 to trade even one contract. The smallest price fluctuation, tick, in this contract is 0.001. The value of a single tick is USD 10. After the future on natural gas had fluctuated between USD 2.50 and USD 3 for months in 2018, the price suddenly jumped above USD 3.20 on November 5th. This prompted the trader to open a first test position in this market. First green arrow at the bottom left. When the price rose to USD 3.40 the same day, the trader bought a second contract. On November 6th, the futures rose above USD 3.40, so the trader bought a third contract. It took until November 9th before the trader could buy again. The market went sideways for several days. From September 9th to 13th, the trader was able to buy 6 additional contracts. He was now long by 9 contracts. November 14th was the day when the future began to rise in a parabolic way. During the day, the future rose from USD 4 to over USD 4.80, an increase of 20%. As you can see, the trader bought 4 more contracts on the way up, but soon he had to start to scale out due to the insane volatility. In the afternoon and late evening of November 14th, The trader sold 9 of his 14 contracts. He closed the next 5 the next day at less favorable prices. His assumption that the future would continue to rise the next day, maybe even over USD5, had not materialized, so he had to sell the rest of his position. Although the trader was far from selling at the high of this move in natural gas, he made a considerable profit. This trade only lasted 10 days, an unusually short period for this type of speculation. You see, the trader was able to buy more and more contracts on the way up, thanks to the book profits. Then, he had to scale out of his position relatively fast. In this case, within a few hours. It is important to take this into consideration when market volatility begins to increase disproportionately. In general, this is a sign that the movement is coming to an end. Let us take a closer look at the profits of the traded contracts here. Contract 1. Long, USD 3,200. Flat, USD 4,450. Profit, 1,250 ticks times USD 10 equals USD 12,500. Contract 2. Long, USD 3,400. Flat, USD 4,500. Profit, 1,100 ticks times USD 10 equals USD 11,000. Contract 3. Long, USD 3,430. Flat, USD 4,550. Profit, 1,120 ticks times USD 10 equals USD 11,200. Contract 4. Long, USD 3,550. Flat, USD 4,580. Profit, 1,030 ticks times USD 10 equals USD 10,300. Contract 5. Long, USD 3,600. Flat, USD 4,600. Profit, 1,000 ticks times USD 10 equals USD 10,000. Contract 6. Long, USD 3,650. Flat, USD 4,650. Profit, 1,000 ticks times USD 10 equals USD 10,000. Contract 7. Long, USD 3,800. Flat, USD 4,720. Profit, 920 ticks times USD 10 equals USD 9,200. Contract 8. Long, USD 3,870. Flat, USD 4,680. Profit, 810 ticks times USD 10 equals USD 8,100. Contract 9. Long, USD 3,950. Flat, USD 4,620. Profit, 1,000 ticks times USD 10 equals USD 10,000. Contract 10. Long, USD 4,000. Flat, USD 4,650. Profit, 670 ticks times USD 10 equals USD 6,700. Contract 11. Long, USD 4,100. Flat, USD 4,480. Profit, 380 ticks times USD 10 equals USD 3,800. Contract 12. Long, USD 4,200. Flat, USD 4,450. Profit, 250 ticks times USD 10 equals USD 2,500. Contract 13. Long, USD 4,300. Flat, USD 4,350. Profit, 50 ticks times USD 10 equals USD 500. Contract 14. Long, USD 4,450. Flat, USD 4,290. Loss, 160 ticks times USD 10 equals USD 1,600. Total, 10,420 ticks times USD 10 equals USD $104,200. As you can see, the trade was well worth it, even though the trader had to close one contract at a loss, contract 14. If you have to scale out fast, this can happen. It's important to keep in mind that prices may fluctuate wildly at the end of such a move. And although most of the profit is realized at the end, one should be aware of the corrections or reversals that could then occur. Chapter 5. Should you use stops? The biggest advantage of the scaling in, scaling out technique is to be found in the reduction of the initial risk. The trader who always trades with the same position size takes the same risk again and again. However, if you build up your position gradually, you will minimize the risk gradually too. At some point, it disappears completely. With the fourth or fifth contract, you will have built up so much book profit that you cannot lose anymore. While of course, every time you buy a new contract, you will have a market risk for that specific contract based on your trading capital. The accrued profit protects you from a new risk to your account. That's the fundamental difference that you should understand. And that's why this technique enables you far better risk management than you would have otherwise. Of course, you always have to be aware of a scenario in which an established trend suddenly turns, and the market starts to move massively in the other direction. In that case, your contracts, which were profitable at first, suddenly start to lose. Depending on how many contracts or shares you currently hold, such a counter movement can quickly lead to significant losses. You will then receive margin calls from your broker. As soon as the first margin call comes in, you should not hesitate to start to scale out immediately. You may even need to close the full position, and you will then have to classify this speculation under the category failed attempts. Another way to reduce risk when the market goes in the wrong direction is to secure your positions with stops. Of course, if you've bought multiple contracts and you want to secure them all with stops, things will get a bit complicated. It is up to each trader whether he wants to use stops or not. In fact, when you work with stops, you basically are not building a single position. Rather, you have many individual trades side by side. You split your position into many small trades. There is nothing wrong with that, and I recommend that traders do it that way first. The question is, how you should do it. Because no matter which stop method you use, you will inevitably experience that a short-term correction will put contracts out of the market if
Can
you
you
put
hear
your
me?
close to the entry level.
Yes.
So check this out. We've not had any prime opportunities looking at the 8100 today. I just want to be full disclosure, I've taken 3 scalp trades. Quentin and Keith, y'all know I'm not calling scalp trades for the YouTube anymore, simply because of the slippage that's potentially out there. I might take it on my end, but I'm not going to call it for y'all's end. The only trades I'm going to call for y'all in is the ones that we can potentially scale into. Doesn't mean we're going to scale into every one, but we're only calling the trades that have that kind of potential. Ladies and gentlemen, I'm also going to show you the reason why we didn't. This trade right here is very, very suspect, and it was rigid. It wasn't fluid going down. It gave you an ABC pattern to go back down, which it did work. Just to be honest about that, it did work. I didn't want to call a trade for the gentleman because of what it looked like coming down. That was a trader bias. That wasn't, sometimes it proves right for me, sometimes it proves wrong, but in this particular case, it proved wrong. So, as a full disclosure, yeah, I'm up 13 and a half, and we'll show you what the millionaire plan looks like at the end of every day. And we will also document the millionaire plan every day. So that being said, let's just get back to it and wait on our opportunities. All right.
Did you take that on the 2700 or the 300?
The 900.
Okay, you took it on the 900. Okay.
Right. See, I want to show it to you just so everybody's clear. You can see these are really, I got in one bar and got out the next when it went down in my favor, because every single trade that I've gotten into, if you look at it, and I don't mind sharing this with everybody, I I don't like taking trades when we're at the bottom here because I got that feeling that it might push back up, and it did on each one of these trades. Like each one of these trades gave it to you at the end, and that's why I didn't hold on to it. It gave it to you here, pushed up. Gave it to you here. If you didn't get out, pushed up. Gave it to you here. If you didn't get out, pushed up. You get what I'm saying? So that's why I haven't been calling, because if you get a bad price, don't get into the right price, you're not paying attention, this, that, and whatever the case might be, you don't have much room for error. So to mitigate that, we're only getting in trades where we can potentially stack the trade, everybody. And then that's the ones we're gonna look for. Point blank, period.
But
So
that is scalping method, basically.
yeah. See, I'm doing a scalping method, and then we'll do the scale method when it gives it to us. Ladies and gentlemen, you don't have a trade every 2 or 3 minutes, typically, especially when you're scaling. When you're scaling, you might get 2 or 3 trades a day, right? Because you have to wait for everything to kind of align, in my opinion. There are many, many different ways of trading. I just know if you want to turn a small account into a big account really quick, I've done it many times over, and I know what it takes. So we just have to stick to the plan.
Now I'm gonna ask a question, and it may be off the subject, but this just kind of came up in my mind about the methods. Would you use these same methods, or am I even saying this right? Would you use these different methods, scalping or scaling in, scaling out, for an options trade?
That's a hard one. So let me answer this first. No, I do not ever scale into an options trade, but I would scalp and or hold an options trade. Right? That means that I can get in an options trade, and let's just say the way that we trade options, the way that I would trade options, is I will look for an opportunity to get 100, 200, 300% on my return on my investment. Well, if it gives me that in a day, I'm probably going to take the money. If it takes 4 or 5 days for it to give it to me and it starts building a head of steam, I might give it a little bit more run. And that's how you turn 3%, a 3-digit percent winner, like 100, 200, 300 into 1,000, 2,000, 3,000% winner. And that can happen in the options game. Let me just be very candid with you when I say the markets, by making such a huge move up, after making a move down, it made a move down at the beginning of the year, and then it pushed up. I wasn't looking to get into any options plays so far this year. I'm probably going to wait, because usually you want to get in the first 2 or 3 days at the beginning of the year. It's called the January effect. And the January effect is something that I can discuss in a training, but I don't want to get into it right now because it's rather lengthy. But because it didn't do that until the second week, I didn't want to do that. I may wait to the next quarter to look at some options trading, or wait to the end of this quarter to look at some options trading. There's not to say there are not in many opportunities, because there may be some opportunities, but options require a lot more work.
Gotcha.
So, you have to do some research and make sure you're doing stuff right and all this other kind of stuff, and study the Greeks and know why you're getting in, where you're getting in, and it's just a lot of work. So I haven't looked at any of them thus far this year, since the beginning of the year. I looked at the beginning, but there was nothing to talk about. Okay. So anyway, that being said, we can go back to the book. We'll come back when there is something of potential.
Gotcha.
All right, cool.
Thanks.
I'm stepping away for a second. I'll be back in a minute.
Okay, Keith.
Despite this disadvantage, I recommend that beginners work this way to start with. You must first become familiar with this method and gain confidence, so that at a later stage, you can start to use more generous stops. A beginner using this technique can pull the stop of the first contract to break even as soon as he buys the second contract. He should do the same thing with the second contract as soon as he buys the third, and so on. In this way, his maximum risk is equal to R1, or in other words, it is never bigger than his initial risk. when he bought the first contract. This is a conservative approach, but it is clear and not open to any interpretation. A second option would be to work with trailing stops, which you could set for every single contract on the way. This gives you a bit more flexibility, and it also gives you a better chance to get the maximum out of the trade, which is the big advantage of a trailing stop. Unfortunately, with this method, you will experience that contracts are put out of the market by reversals or counter movements, which of course is especially annoying if the trend continues thereafter. Of course, if a reversal takes 2 or 3 contracts out of the market, you can always buy them back later. But I only recommend that traders who are already familiar with the method do this. A more advanced method of risk management is to hedge the position. With this method, the trader takes the opposite trade at the same underlying basic value, or in a correlated instrument, in order to protect the account from major losses. As a rule, he should choose the same number of contracts that his position currently has. For example, if he has 5 contracts long in the euro-US dollar currency pair, he will hedge his position with 5 short positions in the same market. Should the euro-US dollar turn 180 degrees against his expectations, his stop-sell orders, short orders, will be executed gradually. Thus, he freezes his position, so to speak. In this way, the loss is limited. It results from the difference between the entry price of the long position and the entry price of the short position. It is important to know that not every Forex broker will allow you to hedge positions. Therefore, if you want to use hedging as a risk management tool, you should inquire with your broker in advance as to whether this is possible. Once the hedge has been built and the position is frozen, the trader has several options. He can close the full position, including the hedge, and thus take the loss. In general, this is the best solution. But he can also make partial closures and trade with a reduced position, should the market give him indications that it will develop in the desired direction again. Hedging is a complex topic, and experience has shown that it does not work for the majority of traders. For most traders, traditional stops are still the best solution. I see hedging more as a kind of emergency brake, which only comes into force when the position is really in danger, and bigger losses could occur. In my view, only traders who really know what they're doing should use hedging to protect open positions. Chapter 6. What do you do if the market is going in the wrong direction? No matter how well you prepare trades, you will experience, from time to time, that a position that you currently hold does not work out as desired. Perhaps it is not moving at all, and your test position changes from slightly in the plus to slightly in the minus. Of course, this is the easy version. You can either close the position and wait until something really starts happening, or the second option is to push the stop closer to your entry price in the hope that the market will eventually begin to move properly. Usually you will be stopped out. It is a well-known trader's wisdom that positions that go into profit immediately are usually the best. If they do not, always be careful. On the other hand, if your position initially goes in the right direction, and you are already able to buy 3 or 4 contracts, and then the market suddenly turns 180 degrees, you should not panic. Emotions such as panic are an unmistakable sign that either your position is too big or that this method does not suit you. If the market goes against you for a few hours a day and the losses become too big, instead of hurrying to close the whole position, you can close a part of your position. For example, you could sell the last 2 contracts you bought that are now at a loss, and then watch the market until it turns back in your favor. The big advantage of multiple entries is that you do not need to close the whole position when things are not going well. If you only have 1 contract, it goes without saying that you have to get out completely. When you start working with the scaling in, scaling out method, you will automatically learn to become an active manager of your positions. This technique is based on the insight that the ideal entry into a position does not usually happen. As a rule, you will need to be patient and give your first position time to become profitable. Incidentally, not all trend markets develop in a straight line, in one direction. That's why I recommend trading on higher time frames, such as daily charts or even weekly charts. If your position is showing a decent profit, and you have 4 or 5 contracts in the market, then you do not necessarily have to sell when the market goes against you for a few days. Admittedly, this scenario causes stress for some traders, but you should be able to withstand it if you want to become a millionaire. The only real risk is the loss of your initial capital. You should act when the first margin calls come in, at the latest. As each market evolves differently, there can be no blueprint for building positions. It's up to you to decide whether your position is simply too big, or maybe too small. Your task as the manager of your account is to generate the maximum return with the minimum risk. If you only minimize your risks and do not buy enough contracts if the trade is going well, you violate the second part of this rule. Then you behave like those traders who trade with a linear position management. The whole strength of the method I recommend here is to understand that stock market success has little to do with hit rates or exact entries. You will have success in trading if you understand that profits come in asymmetrically. If you are on the right track, your position should be big enough for you to benefit disproportionately. Your trading history might look like this: minus 270, minus 1,745, plus 200, minus 2,340, plus 14,230, minus 3,140, plus 490, minus 1,300, minus 2,580, plus 45,360, minus 378, minus 1,700, and so on. I hope you understand the idea. The monster profits will only happen if you learn to buy consistently when you are on the right track. Chapter 7. Go Global Macro. Since I recommend that traders should use this method to observe the developments on the global markets, we should also look at the strategy that bears this name, the Global Macro Strategy. This is a hedge fund strategy based on the macroeconomic principles of different countries or regions. For example, if the fund manager believes that the Eurozone is going into recession, he could sell short stocks or stock indices of the Eurozone. He has all the tools the financial sector has to offer at his disposal: stocks, futures, options, currencies, forwards, bonds, or ETFs. Global macro funds thus build positions based on events or shifts in international financial markets worldwide. One of the most famous global macro trades was the bet George Soros made against the British pound in 1992. By the way, I do not share Soros's political views, but I admire him as a trader. Soros then assumed that Great Britain would leave the European monetary system. According to his analysis, in the UK, both inflation and the key interest rate were too high, which had a negative impact on the British economy. His fund then built up a short position of $10 billion in the British pound over the course of several months. For the time, this was a huge position, even for a professional hedge fund. As you might know, Soros does not fiddle about on the edge. His strokes are broad. In the end, the UK had to give in and leave the European monetary system overnight. The pound depreciated dramatically. Soros's profit was over $1 billion, the biggest gain a trader had ever made on a single trade till then. Global macro traders have a clear justification for their trades. Now, such an approach sounds like you should have at least a degree in economics, or a whole division of specialists who provide in-depth analyses of developments in the financial markets, from which the trader can pick out the cream of the crop. The truth is that the managers of these funds know just as little as you. Maybe they have access to more data than you do. Maybe they are a bit smarter. I'm not convinced about that. But the fact is that these people are just as worried about whether the price of oil is likely to rise or not, or whether the UK will leave the EU or not, or whether President Trump will win the next election or not, and what this could mean to the dollar. You actually have an advantage over these specialists. You are not accountable to any customers or investors when it comes to your trading decisions. Customers can always threaten to withdraw their money if you do not perform well, and that can cost you your job. You do not have any of those problems. You can simply speculate fearlessly. The only thing you are risking is the money in your account. And With regard to the information that is available, we have much too much of it these days. The internet is full of news, analyses, and opinions from so-called specialists. I specialize in crises. The reason for this is simple. At some point, you will hear about it, be it in the news or on one of your financial blogs on the internet. Crises occur again and again, and sometimes they have long lead times that give you all the time in the world to find out and build initial positions. When Greece skidded in 2010, the country was on the news every night, at least in Europe. And you should not make it too complicated. If there's a crisis somewhere, your options are limited anyway. Do you want to go short in the currency of the country? Or do you prefer to short sell its most important stock index? Or both? Whether or not you have detailed statistics and data on the country's problems is...
I'll pause for just a second. Just wanted to let you know on your charts they're no longer on the screen. If you can hear me.
Well, say that again. Something happened with my internet. I don't know what happened here. It says,
Yeah, just your charts not showing. Okay.
hold on one second, because I don't know what happened here.
I'll just keep playing until we get it back together then.
All right, cool. It's
There we go.
but it says connecting and hold on one second. Let me see what's going on here. Can y'all hear me fine?
Yes.
See, that says my internet went out, but then it's coming back. So let me see here. That's the only thing I don't like about Wi-Fi. And let me see if I connect. Let me see what's going on here. Let me see what's going on here.
I'll keep playing until we figure it out.
All right, cool. Do that, because for whatever reason it's not connecting here. We'll figure it out. Let me do some troubleshooting on my end.
Not going to make your decision-making process easier. On the contrary, it is more likely to paralyze you and maybe even prevent you from doing the trade at all. Surely until now, nobody has become poor this way, but neither has it made anyone rich. Put simply, you will have to learn to be a speculator who acts internationally, despite limited information. Perhaps an awkward speculator in the beginning, but with increasing experience, you will become a more experienced speculator. And who knows, at some point, you might even become as shrewd as Soros, Rogers, or Paulson. Chapter 8. Look at the big picture. I'm always amazed at how little interest traders show in historical charts. If your main activity is the 5-minute chart, why look at a daily chart, let alone a weekly chart of your market? But if you want to bet on bigger trends, then you should do just that. Study long-term charts. You can find these charts on special websites, such as finviz.com. The nice thing about this site is the overview that it gives you across all markets at a glance. Just click on futures and then on charts. You can see which markets are currently in an uptrend or a downtrend and which ones are going sideways. FinViz lists the most important indices, commodities, bonds, and currencies. It is enough if you visit this site once a week and are aware of what is going on in the markets right now. Now, you may be wondering if it is absolutely necessary to study the price history of a market, not just for the last 2 or 5 years, but if available, also for the last 20 or 30 years, as some traders do. I know a Dutch investor who goes back even further in time. He once invited me to his home because he knew I was involved in the stock market. After chatting over a good cup of coffee, he invited me into an adjoining room, decorated with old maps, with a large oak table in the middle. He asked me to sit down, and then he suddenly took several large, elongated notebooks out of a cupboard and placed them on the oak table in front of me. As it turned out, he had compiled these books himself with the utmost care. There's only one copy of these in the world, he said. I was not quite sure whether he was joking or if he had spoken with an ironic undertone. Anyway, I was amazed when I started leafing through one of the notebooks. Each sheet represented the historical price history of a market. He had the Dow Jones, the Dutch AEX. He had bonds, commodities, and currencies. It was really fascinating because some of his charts went back over 300 years in time. This trader knew, for example, what the price of wheat was at the time of the French Revolution. He knew the price of coffee when the first coffee houses were opened in London and Paris in the 17th century. For gold and silver, he needed 2 pages because these charts went back over 800 years. It was fascinating to see what this trader had put together in the most laborious work. He had this information from a particular person who specializes in the presentation of such long-term charts. You may be wondering how it is possible to have such chart histories, especially since the habit of grouping stocks together in an index did not materialize until the end of the 19th century, when Charles Dow invented the Dow Jones Index. This was done by collecting the most important stock data before the index was introduced, thus calculating the Dow Jones backwards. At first, I thought that his hobby, as he called it, was in fact a leisure activity. Because what does it matter if you know today what the theoretical, recalculated, dollar price was at the time of the American War of Independence? The Dutch investor seemed to take it all very seriously. The Dutch, as we know, invented the stock market. And the more I talked to him about this or that historical development in certain markets, the more I got the impression that he actually used his charts to speculate. Of course, such calculations should be treated with some caution. As I flipped through his notebooks, he repeatedly pointed to one spot or another in an index or commodity chart, and I said, I think it will take us another 4 or 5 years to reach that level. Then it will become interesting. I could see a little twinkle in his eyes at the thought. He left no doubt. He had the patience to wait 4 or 5 years before investing in this market or that. Of course, you do not need to do your historical research as extensively as this Dutch investor did. But I was a bit jealous of his method. He has perspective, I thought. I could imagine him sitting at his oak table every now and then, leaning over his charts, and maybe thinking, okay, let us wait 2 more years before we do anything here. I learned 2 things from this man. First, patience. Not only had he printed his charts, highly recommended, but he kept them like art books so that he could look at them with the necessary respect and distance in order to think about their development. This Sunday perspective gives him the necessary distance to look at something in peace. This is hardly possible on a screen. The price fantasy that offers such a long-term perspective is even more important. If you look at Dow Jones' hourly chart, a perspective my Dutch stock market friend could only laugh at, how much price fantasy do you have? 500 points? 1,000? This Dutch trader considered a Dow Jones of 25,000 points, merely as an intermediate step on the way to 100,000 points. When I was with him, the Dow stood at 9,000, I think. Because of his historical view, he had this price fantasy. He could not tell me exactly whether we would reach the 100,000 in 2040 or 2045, but he was pretty sure it would happen in about that period. I am telling you this story because it shows that without such price fantasies, you cannot become a successful speculator. You have to take a bird's eye view and forget the daily back and forth on the stock market. All of this is just noise, and it happens to confuse you. To speculate, you need a clear mind and a perspective that deals more with weekly and monthly charts of a market than with hourly charts, or even shorter time units. If you want to know where the money in the stock market is, that is where you will find it, in the weekly and monthly charts. And if you're looking for clear entry or exit signals, I recommend using Heikin Ashi charts whenever possible, because they also filter the daily noise out of a chart. Here are some examples. See Image 4, USD, CAD, weekly chart 2014 through 2016. Look at this weekly chart of the US dollar/Canadian dollar currency pair. Each candle represents 1 week of trading. I think the trend on this chart is clear. As soon as the color changes, you can close the position or even trade in the opposite direction. If the color changes again, you should also close or change your position. Is it that easy? Yes, it is. See Image 5, Amazon, weekly chart, 2015 through 2018. This weekly chart of the Amazon share may be even clearer. Sure, Amazon was in a clear upward trend during this period, but look how easily the Heikin Ashi candles could have helped you to build significant positions in such a market. See Image 6, Apple, weekly chart. Or, a current example, in the last quarter of 2018, Apple stock made a serious downward move. Black Heikin Ashi candles. But then, after a doji arose, the perfect entry signal for a long position came in January 2019. Chapter 9. Look for a catalyst. Of course, you can go along with the trend, according to the examples in the previous chapter, but then you will actually be a trend follower. There's nothing wrong with that, but please do it with the market leaders. In other words, with the shares that are also being bought by the big funds. Then you have a good chance that your speculation will work out. However, in the past, I often got really good results when I found a market that started moving because of a fundamental change. What else should move a market, if not some dramatic news, a positive or a negative? In order for you to speculate on such a dimension, you need a catalyst. What do I mean by that? A catalyst is an event or development in a market that fundamentally changes the perception of the players involved. So, this is not a message that is going to push the price up or down a few percent in the short term. Not even a negative outlook or the downgrading of an analyst firm is enough to fundamentally change the perception of a company. Even sudden news, for example, a market approval of a drug in a biopharmaceutical company.
You want me to show my screen while you figure it out?
The market opens up.
That's not a bad idea. Keith.
Yeah, so Keith, go ahead and share your screen, man, because I've got my backup internet up, but my backup internet is not fast enough to run the charts for whatever reason. So yeah, do that. Because while I still troubleshoot here. Are you sharing your screen?
I'm not.
Can everybody see his screen?
Yeah, I can see it. Everything's flush.
Yeah.
Yeah.
Yeah, I'm sitting over here. Let me finish doing my troubleshooting here.
We're watching it, man. We're gonna play this audio and then we'll keep looking at it.
A huge price gap after news like this. Thus, the news is already factored into the price. Of course, the stock might continue to rise, but there are no guarantees. The same applies to surprisingly negative corporate news. Here, the stock opens with a discount down. Thus, the bad news is also factored in. All these events are hard to predict and even harder to trade, unless you trade the technical counter movement. I described how to do that in my book, Trade Against the Trend. Short-term or unexpected news does not really help you when speculating on big trends. That's why you can confidently disregard them. The same is true for surprising results of elections or referendums, as was the case with the Brexit. If on the eve of such an event, you take a long or short position on the British pound, this is like gambling. You cannot really speculate on dramatic events, such as the Frank-ageddon, red arrow on the left in the chart. That incident took just 25 minutes, and no one, or hardly anyone, expected it, especially as the Swiss National Bank had publicly announced a few days earlier that it would stick to the euro-Swiss franc peg of 1.20. Even central banks are run by human beings, and as you can see, they change their minds anytime. See image 7, euro, Swiss franc, weekly chart, Heiken Ashi, 2014 through 2018. Of course, as an investor, you could have gradually built up a long euro-Swiss franc position after the dust had settled in the Swiss franc debacle. It was safe to assume that the market had overreacted and that it would correct the exaggeration. The euro-Swiss franc plunged from 1.20 to 0.96 within 25 minutes. This actually did happen, and the euro-Swiss franc actually reached exactly the lower edge of the former SNB peg, black arrow top right in the chart. However, the pair needed 3 years to do so. This violates our rule of wanting to grow our account fast. Such investments are interesting, but they usually take more time. Anyone who knows me a bit knows that despite all the information available on the internet, I still like to read the newspaper. One may think that I am old-fashioned or a bit eccentric. Let me briefly explain the reason why I cling to this habit. For the younger readers, a newspaper is an information medium printed on light paper that is usually found hanging on a hook in good cafes. When reading newspapers, the speculator should learn to filter out the messages that are important to him. Of course, that's easier said than done. The old Hungarian speculator, Andrei Kostelany, whom I refer to here, taught that one should learn to read between the lines. He meant that the actual news in itself is usually not interesting, because it is in the newspapers at the moment, so everyone knows about it. When reading an article, a column, an opinion, or a commentary, you should pay attention to certain remarks or asides, because they may contain interesting information that you may have overlooked by merely skimming over the news. And that's why I actually recommend going to the coffee house every now and then and grabbing an old-fashioned medium like a newspaper, because you still need to bring in that necessary element of unhurriedness in order to even acknowledge such information. Unfortunately, you cannot smoke cigars in most cafes anymore, a weak-minded decision in my eyes, because that would slow down your reading pace even more. If I have the time to do this on my terrace at home on weekends, I often find that kind of information, small comments, or interesting asides that grab my attention as a speculator. It's exactly these remarks that can get a thought process going. For example, the question might be, what effect could this event have on this market or that one? As a current example, February 2019. The so-called Dieselgate could apply. Several car manufacturers, especially Volkswagen, had carried out illegal manipulations in order to circumvent the statutory limits of car exhaust emissions. That's the news. Now, as a speculator, it is your job to think about what such an event might mean for the stock market. Of course, the immediate thought is to short sell the shares of the affected car manufacturers. The main candidate here was the German stock of Volkswagen, which was one of the main players in the scandal. However, if you look at the chart for this stock, you immediately realize that the news was factored in by the market within a very short time. The stock fell from euro 168 to euro 105 on the Frankfurt Stock Exchange in just 3 days. So here too, the actual news doesn't help you much. The stock market reacts immediately and only smart day traders are able to benefit from such an event. Volkswagen stock was therefore not of much value in terms of speculating on the diesel scandal. As Castellani aptly said, if you only read the headlines or the mostly boring annual reports, you will usually only learn what everyone already knows. So, in connection with an event of such a dimension, you need to dig a little deeper if you want to find an idea that is interesting to speculate on. And indeed, in the months after Dieselgate hit the news, there was an indirect profiteer. As this scandal gradually made it clear that diesel vehicles had fallen out of favor, there had to be other vehicle technology that would benefit. At first, of course, one thinks of electric vehicles, but that is still a very young market. Those who thought logically came to the conclusion that initially, more gasoline cars would be purchased. The increased demand for gasoline cars eventually had consequences for the precious metal palladium, which is needed for the catalytic converters. Gasoline emissions are cleaned with palladium catalytic converters, and diesel emissions with platinum catalytic converters. Since the emissions regulations worldwide, but especially in China, had become more stringent, they required a higher proportion of palladium per catalytic converters. The results can be seen in the palladium chart. The arrow marks September 2015, when the Dieselgate news broke. As you can see, it took some time for the market to change, but gradually, the insight prevailed among the market players that a fundamental change had taken place. Investors also had plenty of time to position themselves in the market. You see, the new upward trend in palladium only became noticeable gradually. In this case, the catalyst for a stock market trend was literally the catalytic converter. See image 8, palladium, 2015 through 2019. For comparison, the chart of platinum in the same period. See image 9, platinum, 2015, 2019. So you need a catalyst, an event that moves or fundamentally realigns a market for a while, as was the case with palladium. Of course, the catalyst can also be politically motivated. For example, when presidential elections in the USA are imminent, American presidents or presidential candidates tend to be classed as stock market friendly or stock market unfriendly. In the run-up to such elections, the stock market can rise in the hope that the desired candidate for investors will win. But even after the elections, the stock market can rise. This happened, for example, in November 2016, when, much to the surprise of many, Donald Trump moved into the White House. Since this was not expected by most analysts, they suddenly remembered Trump's attractive election promises for investors, such as generous tax cuts and all sorts of deregulation. The election results were followed by a veritable Trump rally in US stocks. Wars can also become a catalyst. As the stock market anticipates future events, it often reacts or overreacts in the run-up to the expected event. This was the case in the weeks leading up to the Second Iraq War in early 2003. The threats and the rattling of sabers in the media caused prices to tumble to the bottom. When the war began, as the first bombs fell on Baghdad, the stock market considered the matter to be over and done with, and it began to rise up again. This phenomenon can be observed again and again. Even in the run-up to the Second World War, it was no different. When the threat of war was imminent in 1939, the stock market fell. As soon as World War II began, stocks began to rise again. This phenomenon is described by the French term fait accompli. In English, accomplished fact. This moment occurs when all relevant news is factored into the price. Why is that? Basically, speculation can only be based on a future event, so on something that might happen in the near or distant future. Therefore, a savvy speculator should direct his attention to the markets in which a future event is expected, hoped for, or even feared. If all the news has been factored into the prices, and no further news is expected for the time being, what remains that could move the prices? And of course, the more dramatic the event is, or is likely to be, the more the prices will be exaggerated, until the market surrenders completely, down, as in 2008 financial crisis, or skyrockets, as if there is no tomorrow. See Bitcoin 2017. There is no need to explain that the most money can be made in such markets. The events do not always have to be so dramatic. If investors expect a company to deliver excellent quarterly results, they will buy the company's stock in advance. In general, this is a good opportunity for a speculation that lasts a few weeks. This method works particularly well with the current market leaders, i.e., the Apples, Alphabets, Facebooks, and Amazons of this world as of 2019. The speculator should close his position the day before the quarterly numbers come out. Quite often, investors will sell the stock on the day of publication, even if the results meet investors' expectations, or for that very reason. Fait accompli. Of course, the opposite also happens. If investors are pessimistic about the numbers, they sell the stock ahead of the release. If the numbers are better, or less dramatic, than expected, this news must be factored into the price. Often, it jumps and goes up for a few days. Such an event is rather less suitable for the method mentioned here, but it can be a good opportunity for short-term oriented traders. The phenomenon can also be observed with regard to announcements by the central banks. If a central bank chief announces that he is going to raise rates, and this event is widely anticipated by market players, a multi-week rally will often start, even though interest rate hikes are generally negative for stocks. Here too, fait accompli. If everyone knows that the central bank is going to raise the interest rates, then this negative news for equities is already factored into the price. So stock prices can go up again. As you see, the stock market has its own logic that you need to study if you want to be successful. Why is the interest rate so important to the stock market? The increase in interest rates affects monetary growth, and the money factor is the oxygen that keeps the stock market alive. When the world's major central banks cut their key interest rates to almost 0% in the wake of the financial crisis, money became cheap and sought ways to be invested. Therefore, in the years following this measure, people were building houses like crazy with all this cheap money, and a lot of money was invested in stocks, because with the dividends, you could at least make a small profit. Chapter 10, Mistakes to Learn From. After my silver trade, I wanted to repeat my coup. I will be honest. Since the success, I have made several mistakes, which I do not want to conceal from you. I speak of them here, so that the reader can learn from them, and hopefully not repeat them. I am not ashamed to have made these mistakes, though I am still a bit angry about them today. I hope that the trouble will be the fuel that ensures I'm on the right side.
Said something, Keith.
No, I laughed what he said. He
All right.
said, I'm still a little angry about him today. I'm just looking, waiting for the 8100 to try to cross up and give us a complete trend up, but it didn't happen.
Yeah,
It's going back down.
it's getting close to lunchtime, so we'll see what to do.
When the next opportunity comes around the corner. Even though the events of that time, 2008 financial crisis, occurred more than 10 years ago, it is still interesting to recall them. The mood at the time was so bad that I assumed that every correction in gold and silver was an opportunity to buy. Not even close. After silver had reached a high in early March 2008, it fell continuously during the course of 2008. I bought silver again and again, and I had to close my positions at a loss each time. The result was that at some point, I no longer dared to buy silver, and then the inevitable happened. Silver bottomed out at USD 9 at the end of 2008, and then it began to rise again in December. I was so annoyed by my losses that I did not dare to buy. A big mistake, as I found out later, because December 2008 was the starting signal of one of the largest bull markets in silver ever. Silver rose from USD 10 to almost USD 50 in just over 2 years, more than a 5-fold increase. Although I traded in silver in this period, I was never really able to benefit from this megatrend and all that, even though I was able to take a good deal of the upward movement in 2007, 2008. But the subsequent movement in silver was 10 times as big. You can figure out what I could have earned in such a market. See image 10, silver 2006 through 2019, monthly chart. As if all that had not been enough, I tried to go long in silver after it had achieved its high in April 2011. You can clearly see in the chart how successful I was with this. To say I was a bit late with my silver trade would be a real understatement. I was so obsessed with silver that I did not see anything else. I thought the whole financial world was in a kind of permanent crisis after the so-called financial crisis of 2008. So investing in gold and silver must be worth it. Not even close. The bull market in silver was over, and the only right thing to do would have been to take a short position. But I could not think that far at the time. I was fixated on crisis. So silver and gold long. A big mistake. The lesson I learned from this sounds simple. If you have had a big success in a market, it is best not to trade that market for a while, no matter what else happens. As a rule, you will take the wrong position the second time around and lose money. The reason is simple. Emotionally, you are too dependent on this market. It has been good to you and has given you a decent profit. At the moment, in my experience, the most dangerous thing is to re-enter. It is better to look for an opportunity in another market.
Hey, gents.
Page 11, Dow Jones 2007
Yeah.
through
So my apologies, man. I have a backup internet that allows me to, in theory, quote unquote, not get get disconnected from the exchanges. But for whatever reason, there was a glitch or whatever the case is. I had to get on the phone and find out what was going on. They just told me to restart everything and it should be working. So now I'm back up and I'm ready to go. But that's a sign for today. And I'm gonna tell you what the sign is. If you look at the Keith, can you expand your 8100? We won't change anything right now since we got it consistent. And then I'll switch back over when you need me to. If at any time during the day you need me to. And take that. I mean, you don't have to take anything off. So if y'all can look at that, that's real. I mean, what you want to do with that?
And that you can do.
That's about as flat as you can get, right? Even if you try to give it some angle, it's not going to have much angle because this right here is just, it could go either way. And the reason why it's doing that is because it made, in the last 2 days, it made like 1,000-point move up to the upside on that daily chart. As a matter of fact, don't let me lie to you. Let me make sure I'm telling you the truth. 3 days, or let's talk about 3 days from the 118 till today. And 118 had a low of 16,834. Today has a high of 17,585. So it's moved up 700 points. Right? So about 800 points. So it's made a really, really big move in a short period of time. So there are some scalp trades that have happened that you could have taken advantage of, but nothing to write home about. So we're still watching, and I'm still watching it. Got everything back up and running. I apologize for the technology error, and now I'm glad we got it fixed so we can go on about our business. And with that said, you can go back to your regular charts, Keith, and you can play it, Quentin.
All right. Let me ask you a quick question though.
All right, go ahead.
Being that it's in such a tight consolidation, what should we be looking at? Because see, once it breaks out of that consolidation, it is probably going to go big to either the up or the downside. So we really need to be, just kind of wait for it to break out. But what particularly should we be paying attention to expect that breakout?
We'll
Because I'm-
watch that.
Right.
Let me do some. Let me do it since you asked that question. Let me do a quick deep dive. Uh, One Sacramento, and I'll let you know. It's tough. So let me tell you what I got, right? There ain't really a whole lot you can do except wait and see if this extra long time frame, which is I'm looking at a 72,000 volume chart, is in a definitive higher, I mean, it's in a definitive uptrend with a higher low forming. And then if you go down to the 24,300 chart, 24,300 chart, you run into a situation where you have an ABC pattern to go back up, but it's one of the things like when everything's not in sync. So what you need, well, in my opinion, what we have to do is, right? Just an opinion. In my opinion, what we have to do is wait on this 8,100 to either break out of the range to the upside or break out of the range to the downside, because now she's gotten back up into the range. And if I'm looking at Keith's chart, that's serving as a resistance point right now. But I can assure you that it's going to continue to go higher. And the reason why I can tell you that is because it's gotten back up into that resistance. And strictly looking at the bars on Keith's 8,100 chart, price continues to push higher. And when she tries to push lower, she doesn't do it with any kind of velocity to the downside. It keeps pushing to the upside, so that lets me know that there's buying pressure out there. And you just gotta wait. I mean, at the end of the day, in order to catch those big trades, you do have to wait, right? And that's what we gotta do. We gotta wait on the opportunity. And so that would be my suggestion. We just there literally is nothing to do until she breaks out up or down. And I don't foresee her doing that here in the next. She might do it in the afternoon, but I don't see her doing it in the next 30 minutes to an hour. Because now you're near the lunchtime hour. I think I heard somebody say that earlier. Now you're near the lunchtime hour. It is Monday. It's coming off of a very big move, so it's got to breathe. It ain't no different than somebody running 100 meters. The thing ran 100 meters as fast as it could, and now she got to rest, which is all that's happening. She's just resting right now. So we wait on her, and when something happens, I'll definitely be there to see it. Keith, I see you're up 9 and 7.75. I see you're up 9.75. I'm up 13.5, but they're scalp trades. How many trades have you taken today, Keith?
They got me down by
Huh?
trade. I've taken one trade.
You've taken one trade?
Yes.
All right, cool. So, I mean, it's not been anything to be had. And I'm assuming that trade was a short.
Oh yeah.
So,
I can show it to you.
yeah, let's see it. Let's while we're on, let's analyze the trade.
While y'all do that, guys, I'm gonna go on mute for a second. I gotta make a call here to the store.
Okay, cool, man. Take care of your business.
All right.
Oh man, that was
Touchdown, popped up, got in here, and got in right. I got in on this bar, and got down to here, which gave about 15 points. And our goal was to get out with 12. If it started, I wanted it to go down, but if it started going against me, I was gonna get out. Once it got to 12, I was gonna getting out. But it got me out at 975. So
I mean,
and then it
so
went against me. And this is where I would have got out based on the system. So it would have been 80.
86. So you'd have made 11 points on that trade.
Yeah, I would have made 11. Got out when I was supposed to.
No, that's all right. That's all right. I mean, just again, we're trying to catch the big fish, but it's hard to catch the big fish. And that was a 1025, right, Keith?
Sure, I'm gonna lie to you. 10/28/34.
Hey, hey,
Look,
10/28/34. That was the trade right there, boss. Everything was that was a nice one. That was a nice one. So all right, cool. Well, we're here waiting and we'll just see what happens, ladies and gentlemen. I'm gonna go back on mute. I know Quinn is on mute, so we'll go on mute here for a minute. Um, I'm looking. Any questions for me, Keith?
no, not at the moment. I'm waiting. Let's see. That was the first. That's rough. That was the first, but you don't get set up to here. So waiting to see about this, see where it ends up at. I know we got resistance we got to go through, make all this work for long, but waiting to see what it gives us.
All right, cool. Well, man, we'll just go on mute here for a minute and we'll be back shortly, everybody.
All right.
All right, I'm back and I will start up the audiobook.
All right.
Profit. At the moment, in my experience, the most dangerous thing is to re-enter. It is better to look for an opportunity in another market. See image 11, Dow Jones 2007 through 2019, monthly chart. As if this amateurish thing was not enough, I tried my luck in the stock markets in the months that followed. They had recovered well after the crash of 2008. In 2011, the Dow Jones had almost made up for the losses of the financial crisis. The stock markets had been rising for 2 years, influenced by the
Oh,
euro.
shoot. This might be your first system
Caused the
trade,
big
but
rise of
they
gold
give
and
you the
silver.
ABC pattern. Let's see. You got a break below 9.
On your 900.
Yeah, on the 300. This is what you got. You got a higher low right here. 8,100 long term and short term momentum was up. Then you got market structure right here. So you want to see how this pullback plays out. And then you got your ABC pattern. 1375. So that's an ABC pattern. And the entry. And how we enter it. That's the green bar break entry. 3-bar reversal. 0950. 501. But you are concerned, he mentioned earlier, the concern might be this resistance over here. But that's your setup. I think that's the first. I think that's the first setup we've had. And the trade didn't trigger. Back to 0950. 125. So 819. 8.25. We'll have to get by 18. You see this long? It's on,
Say that again, Keith.
I'm not sure if we still doing this or not, but it's not triggering. It's taking too long. I don't like it no more. So we had based on using all the charts. You got a high low here. You got a market structure right here. And you had an ABC pattern trying to form right here, but it looked like it's struggling. Now you're about to get a bar to close below the 9. So still trying to do it. 100.
So let me tell you, the way I'm looking at it is you do realize that thing is going up into resistance, right?
Yeah, I mentioned that earlier. I said that was the only concern I had about it, that it was going into resistance.
So you have to be careful of that. Plus that 900 made a move already that could turn into a complex ABC pattern and come back down.
Mm-hmm.
Not saying it's going to. I'm just saying what it looks like. Uh, and we don't want to be in here, you know. We don't want to be in here tripping. And when I say tripping, I mean this is also an ABC pattern that come back down on the 8100. So it's just you got a certain chart saying up, you got certain charts saying down, and that's why I tell people you have to really look at price flow because unless you're trying, the only way you don't really have to, and I'll tell this for full disclosure, price flow is not as important to your immediate trading the larger the time frame you go out, right? We're trading smaller time frames. So if you're trading a 15-minute chart or a 5-minute chart or 8100 volume chart, and it gives you a setup, the probability of that trade actually working for you to some degree is extremely high. Extremely, extremely, extremely high. Okay. By being that high, you can trade off of those larger time frames and everything doesn't have to be aligned. But when you trade these smaller time frames, you need to have larger time frame alignment. That's the bottom line, right? And right now, this thing is trying to turn over. Right, it's trying to turn over here, so we'll see if we get alignment. Alignment here. Are there any questions for me at the present moment?
No, good. That was clear.
Yeah, okay, cool. So we just sit here and, I mean, you sit here and wait because playing up in here, you can definitely can have a problem. So that being said, we just sit here and wait. Ladies and gentlemen, we just sit here and wait.
I was still in crisis mode. I did not go long in the stock indices. I went short. I thought this recovery would be a mistake. Meanwhile, the central banks had lowered interest rates to zero. So, I should have known that investors could not make any money with government bonds. No capital going to fixed income usually means that it will seek other assets that at least bring some returns. And what could be more obvious than simply buying stocks and earning dividends? And so it happened. We have been in this bull market since March 2009, as of May 2019. The charts also show it unmistakably, especially the charts of the American stock indices. But instead of going long and just buying the trend and making serious money, I went short. What a mistake. I'm telling you this because these stupidities are not that unusual. Sometimes it is really hard to just do the obvious thing. From 2009 to 2019, we had one of the biggest bull markets in stocks history. So we had 10 years to go long and make money. Over the years, countless crash prophets have called for the end of this bull market. It's not possible. It's all bought on credit. This is a central bank rally that has no substance. You can expand the list of reasons as to why you should not buy any shares during this time indefinitely. There was a good reason why Jesse Livermore tried, by all means available, to block his ears, especially to analysts. All those tips and the people who think they know it all. Nobody knows anything. This has to be clear. Like Livermore,
Stepping away for a quick sec.
I recommend that you listen to nobody, and that you certainly do not waste your time with endless analyses and opinions. That is hard. I did not follow my own advice, and that cost me a lot of money. Believe what you see, and not the opinions of the others. It is better to watch the development of the long-term charts. If a stock index has been rising for 2 years, and it continues to rise, is there any reason to go short? Chapter 11. Success with cotton. I was unable to benefit from the bull market in silver in 2011, but I succeeded with another speculation, which corresponded better to my skeptical nature. Hence the following story. A friend of mine, who lived in Berlin at that time, had a small textile company, with its production site in a small town in the federal state of Brandenburg, in the east of Germany. This fact alone amazed me, because in 2010, there were not many textile companies that were able to produce in any of the former East German states, with their high unemployment figures. Rather, one would have expected the production sites to be in countries like Bangladesh. My friend's company made industrial textiles, mostly workwear for hospitals. It was a niche in which she managed to assert herself over the years, with the help of a loyal team. I really admired her for this achievement, engaging people in that weak economic environment by making clothes. Hats off. We met for a cup of coffee, and I remember that we also talked about her company from time to time. At the end of 2010, she called me, asking if I had time to talk. She knew that I was involved in the stock market. She sounded restless on the phone. When I met her a day later, she looked very worried. At first, I thought that her company had run out of clients, and that she would have to dismiss employees. That had happened in the past. It turned out, however, that her concern was quite different. I have several sales orders, she said, but I cannot deliver. Why? I asked. Normally you always deliver punctually. Yes, she said. That's not the problem. I cannot get any cotton. We're desperately waiting for a delivery, but it's just not coming. So we cannot produce. No cotton, I said. How can that be? Cotton is as plentiful as sand on the beach. I thought it was. She put on her worried face again, and then she began to inform me about what was going on in the cotton market. Apparently, there was a big shortage of cotton. Apparently, when she started to explain the situation to me, I got a little lesson in the world of raw materials. All around the world, cotton is harvested during different seasons. Then it is produced and transported to the spinning mills. In that year, there was a weak harvest in the important production country, Pakistan. Demand had grown steadily in the previous years. Especially China, with its hot economy, was hungry for all kinds of commodities, including cotton. In addition, There were export restrictions. And as if that was not enough, producers in Pakistan and India began to hoard their supplies due to steadily rising prices. They simply are not handing over the cotton anymore, my friend said in a desperate tone. They would rather fill their warehouses in the hope that prices will rise even further. The situation is desperate. In fact, the price of cotton on the Intercontinental Exchange in New York had risen by more than 160% in 1 year. At the time when my friend made me aware of the problem, the price of a pound of cotton stood at USD 1.68. When I looked at the chart at home, her problem became clear to me. In the preceding years, the price had fluctuated between USD 0.40 and USD 0.8 per pound. There was no problem getting cotton at that time. Actually, there was always enough cotton, but the exceptional demand from China and the weak harvest had fueled the price. It was an extraordinary situation. When the producers began to hoard, there seemed to be no cotton available. This was, of course, an artificially induced shortage, but it brought small textile companies, like that of my friend, to the brink of insolvency. For a speculator, such information is worth its weight in gold. I could read the seriousness of the situation and the utter exaggeration in the price in my friend's eyes. Her desperation actually told me everything. She had orders in her books. Heck, the customer was waiting for his workwear, but she could not produce, let alone deliver, because she could not get cotton anywhere, although the warehouses of the producers in India and Pakistan were over full. This information was served to me on a tray. See Image 12, Cotton, 2005 through 2019, monthly chart. I had never dealt with the cotton market before. As I began to study the cotton futures chart in the final weeks of 2010, I realized that I had come to the party too late. The chart had already built a parabolic slope. To enter the last phase of a bull market did not seem advisable to me. Since I was pretty much bearish at the time anyway, I decided to keep watching the futures on cotton and eventually go short. In January 2011, the price of cotton finally rose above USD 2.
I think you got a
Attained
short
high
happening on
of
900.
USD 2.25 in February. I wa-
If it pushes down, if it comes back down, you can get it off the red bar break.
Yeah, it's Keith pushing up though, Keith. You see,
Yeah.
giving you green bars. So I don't see that as a trade because it
Well, it
keeps
has to come
pushing
down.
up right here. Now it
Once-
depends. If this thing comes crashing in, then that's another thing. But because I'm sitting up here watching it, and it's just it always gives you reason for pause. You get what I'm saying? Every time you think, okay, cool, here you go, then you get that pause, and it's like,
Mhm.
yeah, I don't do well with it not doing what I needed to do. So
I'm saying I'm just calling them up. So you can see, I think like now it's closing above, so I was like, but when I saw it, I was thinking, it might touch down about right around in here. But it
and it
didn't.
might go down, but the thing is, now you have for me, you have a trade potentially on your 2700.
Yeah, that's what I was looking at next. Let's see. I'm assuming you're doing the same thing, but you really want that bar right here to close red, right?
So yeah, it's just a matter of
Mhm.
being
All right,
okay. Here we go.
So, yeah, I'd like to see that right there come into play.
In order for this to be a trade on a 900, you're gonna have to. I mean, when I say have to, this bar here cannot close above that 20 moving average, because if it does, that breaks the rule of
Yeah.
having multiple bars closing above. But if this thing pushes down here in the next 300 contracts for me, then that might be something.
It's long-term minimum of 8,100.
That long term, what now?
Long-term minimum of 8,100.
Yeah, it's
That makes it counter trend. Yeah. ABC pattern of 8100. Would that have been the entry right down that red bar break?
Yep.
No, it's not in this column.
Keith, that last bar that just printed didn't break that previous high,
Which chart?
900. That's what you were looking at? Or you were looking?
Well, right there, high, low, the ABC pattern if it does, but right now, it didn't break it, but you had this bar closed above, this bar closed below, this bar closed above, so you're still waiting to see what that bar do. If it crashes down, that might be something of interest, but what if that to happen? But technically, you in this trade right there, because that was your stop, red bar break, and the 3-bar burst. You got you in by a tick. So if you was in it, if you was taking it, you'd be in it already.
Would that be for a scalp trade or a trade where we scale in, scale out?
I doubt you scaling in at the moment.
Okay.
It's still in that resistance though. I mean, it don't look like resistance right now because it's smaller scale. But put it like that, it was bunched up. But like this right here, you still got a resistance range that it's in.
Mm-hmm.
So you still, and look how flat it is right there.
I do.
It's probably best not to do anything right now unless you just feeling a little froggy. But
I ain't mess with that, man. All right, I'm gonna turn it back on.
All right.
The future every day to see signs of weakness. When I realized that a price above USD2 was not sustainable, I went short with a first position, just under USD2. The position immediately went into profit and was never in danger. Encouraged by this confirmation, I opened further short positions, which also went into the plus relatively fast. The volatility was extreme, and the PL, profit to loss, on my platform changed to my favor or disfavor, faster than you could imagine. Not for the faint-hearted. Unsurprisingly, due to the twisted mood, the first bearish news for cotton came in. Instead of the expected demand of 120 million tons for 2011, expectations were revised downwards. Only 113 million tons were expected. Demand began to slow down. First and foremost, from China. As if that was not enough, the first reports of very good harvests came in. India expected an increase in production of 255,000 tons. Similar news came from West Africa, Turkey, and Greece. Of course, that was news that did not really give the cotton price wings, so to speak. On the contrary, although there was a technical correction in April, I remained short and even expanded my position. My assumption that the upward movement of 2010 would be completely corrected was confirmed. In June, the price finally reached the USD1 level. The price had thus more than halved. I gradually began buying back contracts to close my position. Once again, it was an incredible ride, but I managed to make a decent profit with the cotton crash. I had never been able to trade such a downtrend and came away feeling quite satisfied, though my enthusiasm was somewhat subdued by my previous bad investments in the stock market. I called my friend and asked her how things were going. Everything was fine, she said. Cotton was readily available again, and her company was able to produce and deliver on time. Although my short cotton position is unlikely to have had much influence on the price, I modestly helped to push the price down. This corrected the bubble, which was ultimately the result of an artificial shortage. This time, the real evil speculators were certainly not the short sellers, but clearly the greedy producers, who hoarded more and more cotton due to the rising prices, thereby fueling the price even further. The cotton crisis of 2010, 2011 was really life-threatening for my friend's company. Of course, you cannot consider her report as insider information about a particular market. She was far too helpless herself at the moment. But the story taught me that such crises may well contain valuable information, especially emotionally vivid information that may offer the opportunity for successful speculation. It pays to go through the world with your eyes and ears open. Chapter 12. My ruble trade. It is well known to every trader that the price of oil is an important factor on the world stage. It is therefore essential that you keep an eye on it, as well as on other important indicators, such as the dollar or the yield curve of US government bonds. Whenever capital is withdrawn somewhere and flows to another place, it is often because something important is happening in one of those indicators. See Image 13, Oil Price, Monthly Chart, 2003 through 2019. Between 2007 and 2008, the oil price was in a spectacular bull market. An excellent chance to make a fortune, by the way. After rising to over USD 140 a barrel, the price plunged below USD 40 a barrel after the financial crisis. It was an unprecedented crash that took just 6 months. Again, an excellent opportunity to make a fortune with short positions. Between 2009 and 2014, the oil price recovered and reached a price of USD 100 again. Then all became quiet. Oil seemed to stabilize at that level. Technically speaking, it formed an extended symmetrical triangle. If you ask me, this is not a very reliable technical pattern. There were smaller breakout attempts to the upside, all of which failed. I was already lurking in the shadows because I assumed that oil would eventually break out to attack the highs of 2008. However, this did not happen, and the price continued to go sideways at around the USD 100 level in the first 2 quarters of 2014. And as so often happens on the stock exchange, when the expectation of market actors, including myself, is not fulfilled, the opposite happens. Oil broke out of this sideways pattern on the downside in the summer of 2014. The crash was not as spectacular as in 2008, but still a slide from USD 100 to USD 27 is spectacular. That's a loss of value of 73%. I have to admit that I was completely surprised by this crash. Once again, I had been deceived by my expectations. The price of oil just had to rise because the world needed more oil and the supply was becoming scarcer, I thought. I could just watch the oil price going down day by day. That is what you have to deal with when you have certain expectations. And then the opposite happens. You can only stand on the sideline and watch. But it got even worse. I did not get in, not even with a small test position, because I assumed it was a false breakout. I expected the market players to suddenly take a 180-degree turn. In the end, this did not happen. It was a real breakout, and the price of oil continued to fall. Of course, the analysts were soon on the spot with their explanations. There was more oil than everybody thought. How interesting. As if this oil had not existed in 2011 and 2013, when oil was stable at above USD 100 a barrel. The second explanation also seemed obvious. This time, the Americans, more specifically, the shale oil boom, had caused the price to collapse. In just a few years, The US had become the largest oil producer in the world, relieving itself of its independence on Saudi Arabia. All this seemed to catch the market players' attention in July of 2014, although they couldn't have cared less about what the Americans were doing in May and June. You see, the analysts always have their explanatory models ready, but they do not take them out of the drawer until the market begins to confirm their assumptions. That autumn of 2014, I pondered as to how I could still benefit from this movement. The opportunity came, but from a very different side than I expected. I should have known, but it did not dawn on me until the first news broke, that the Russian ruble was in trouble. What does the ruble have to do with oil? Pretty much. 2/3 of Russia's exports are oil and natural gas, and the gas price is mostly geared to the price of oil. Half of the Russian taxes come from these sources. There are also some other countries that are heavily dependent on oil prices. Canada, for example. And indeed, the Canadian dollar also slipped in the fall of 2014 against most other currencies, most notably the dollar. A long position in the US dollar/Canadian dollar seemed a logical consequence. Long US dollar, short Canadian dollar. But for some reason, I was more interested in the Russian ruble. It was a currency I had not traded before. It does not belong to what you can call the usual trading instruments. Basically, because the spread on the spot markets is far too high. The ruble had indeed depreciated against the dollar in September and October. See image 14, US dollar/Russian ruble, daily chart, September through December, 2014. The US dollar/Russian ruble pair rose from 35 to 42 to 43 in September through October 2014. In the case of the US dollar/Russian ruble exchange rate, rising prices meant that the US dollar was appreciating and the ruble was depreciating. There had been an upward trend, but there were still no sign of an emerging buying frenzy, selling frenzy for the ruble. However, this changed in early November as volatility increased significantly, and the US dollar/Russian ruble suddenly rose to 48. I bought a first test position at the end of October at 43 and felt that my assumption that the ruble could continue to depreciate had been confirmed. Of course, there were reasons for the crash of the ruble. The West imposed economic sanctions on Russia in the wake of the Ukraine crisis, Crimea, which were now beginning to take effect. Well, the 2014 ruble crisis was not the first. During the last ruble crisis in 1998, it was already all about oil. And this time, the further crash of the oil price in the last quarter of 2014 seemed to accelerate the fall of the ruble. The Russian oligarchs withdrew their money from the Russian accounts and placed it in dollars, Swiss francs, or euros. When the smart money gets out, it accelerates the depreciation of the currency. During the course of November, I started to expand my position. Although the ruble mostly went sideways, I even had some losses, as the US dollar/Russian ruble fell back to 45 in late November. I was thinking about reducing my position when the US dollar/Russian ruble started to rise towards the 50 mark in the last few days of November. I started buying again. Meanwhile, the price of oil had fallen below USD 70 and was heading towards the USD 60 mark. For the first 2 weeks of December, the USD/Russian ruble continued to rise, reaching 55, which prompted me to further expand my short position in the ruble. I now had serious profits. Finally, on the 12th of December, the 55 level was conquered, and the USD/Russian ruble appeared to be heading towards 60 in the third week of December. 60 rubles to a dollar. In Russia, queues formed in front of the exchange offices because everyone wanted to get rid of their rubles. People began to spend their money and bought electronic devices, cars, and non-perishable foods. A scenario set in, similar to the situation in 1998, when the Russians lost confidence in their own currency. Of course, the Russian central bank stepped in. The central banks are always the most important players in the matter. On December 11th, they raised the key interest rate from 9.5 to 10.5%. The central bankers stepped in, although as recently as October, they had raised the key interest rate by 150 points due to an expected rise in inflation rates. Contrary to their expectations, this measure could not stop the fall of the ruble. The market had obviously expected a larger move in the interest rate. The ruble fell further. Although there were rumors that the central bank had intervened in the foreign exchange market several times, but that did not stop the downward move of the ruble. After the weekend, the decline of the ruble continued. The US dollar/ruble rose to 64. The rate hike of the previous Thursday had no effect. I kept buying and waiting. On Monday night, President Putin finally intervened, forcing the central bank to raise the key rate from 10.5 to 17%. That was a huge increase in the interest rate. It was the same measure that had been taken in 1999 to stem the ruble crisis of the time. On the Tuesday after Putin's intervention, the volatility was insane. The US dollar/ruble was swinging between 60 and 78 within minutes. I was thousands richer or poorer. It was clear that the market had been waiting for Putin to intervene. Only nobody knew how the ruble would react. I watched with fascination as the US dollar/ruble rose to 78. Therefore, I had huge gains with my position. However, during the day, the pair fell sharply, and it dawned on me that we might be experiencing the final act of the drama. I've learned by now that if the chart goes parabolic and the volatility gets insane, it's usually a sign that we may have seen the highs. I started selling, admittedly, not at the best prices. Everyone, of course, wants to sell at the high, although it must be clear that this is impossible. No one knows where the high of this move will be ultimately. I began to systematically scale out my position. After all, I had made considerable profits. I sensed that Putin's radical intervention might be a turning point. The ruble had already devalued vastly, and the possibility of economic sanctions from the West and the crash of the oil price were factored in. I kept part of the position in case even this drastic measure did not work. This assessment proved to be wrong. Although the US dollar/ruble rose above 70 again on Wednesday, it was unable to hold that level on Thursday and Friday, so I closed the position completely. At this point, let me say that some readers may regard this kind of speculation as morally reprehensible. You can see it either way. You can either consider a speculation against the ruble as a reprehensible act to the detriment of the Russian people, or you can consider the devaluation of the ruble as a necessary correction of the market in order to force the Russian leadership to take measures to regain control of the rampant inflation. After all, such a dependency on crude oil is not a healthy basis for a stable economy in Russia in the longer term. The market is forcing Russia to reconsider this position. For one thing is clear: as long as this dependency exists, any fall in the price of oil will put the ruble under pressure. The devaluation of the ruble was necessary for the Russian economy, just as the decline in the cotton price ultimately had a positive effect on the textile industry. It was to the detriment of greedy producers who would have been happy to see even higher cotton prices. You can argue any way you like. As a speculator, it is not your job to save the Russian economy. There are always two sides to trading and speculating: buyers and sellers. And as long as you consider it morally reprehensible that there must be a seller in every transaction, you have not understood why the stock market is even necessary. Sometimes you stand on this side, and sometimes on the other side. If you want to make money, your job is to be on the right side more than you are on the wrong side. That is all. Chapter 13. Thanks to Presidents Erdogan and Trump. In 2017, I already had an eye on the Turkish lira. The inflation rate in Turkey had risen to 13%. That's high, but not unusual for an emerging economy, as Turkey is. The lira began to depreciate in 2017, but all of this took place within a reasonable range. See image 15, Euro/Turkish lira, February through September 2018. From March 2018, the lira began to depreciate a bit more, and in April 2018, when it jumped over the 5 lira per euro mark. I went long with a first position in the euro-Turkish lira currency pair. With the euro-Turkish lira currency pair, rising prices mean that the euro appreciates and the Turkish lira devalues. I had to be patient. The lira hovered around the 5,000 mark for the remainder of the month, and even dipped below that mark towards the end of the month, putting my position a little bit in the red. Since the loss remained manageable, I kept the position. In May, the devaluation of the lira accelerated. As soon as the level of the 5 lira per euro had been reconquered, I bought a second position. I was rewarded for my courage, because soon the pair climbed in the direction of 5,500, which gave me several thousand euros in profits. The causes for the devaluation were varied as always. Probably the most important thing to me were the rising interest rates in the USA. In the months before, this had led to significant outflows of capital from the so-called emerging markets to the United States. This was especially the case for countries like South Africa, Argentina, Brazil, and Turkey. As the Fed began raising interest rates, I realized that this would lead to a general devaluation of the currencies that had hitherto lived off of the US low interest rate policy. Above all, the Turkish economy profited from these capital inflows. The current account deficit of Turkey was, and is, especially large. In short, that means that the upswing of the Turkish economy in the years before was largely built on credit. Another accelerator was the refusal of the Turkish Central Bank to raise interest rates, which is the usual monetary policy instrument to fight inflation and the devaluation of its own currency. This refusal was not voluntary, but rather due to pressure from President Erdogan. Normally, the central bank should act independently of the policy. It is not to be assumed that any politician who happens to become president also understands monetary policy. In the case of Turkey, the central bank was considered independent. That fell away, de facto, after Erdogan's election victory. Erdogan publicly stated that interest rates that were not determined by him were the father and the mother of all evil. As the reader might know, interest-based banking is banned in Islam. As the devaluation of the lira accelerated further in May of 2018, the central bank was only able to prevent a further decline by raising its base rate by 300 basis points, from 13.5% to 16.5%. Although this led to a temporary recovery of the lira, the currency continued to trade above 5 lira per euro level. On the days after the jump in the interest rate, my position suffered, but it was never really in danger. Of course, I expected an intervention by the Turkish central bank, despite Erdogan's rhetoric. A clear increase in interest rates was a signal to the markets and to me. However, the lira did not recover significantly. It did not even recover when Erdogan announced that he wanted to bring the presidential and parliamentary elections forward to June of 2018. On June 7th, the Turkish central bank announced that it would raise rates again by 125 basis points. Although this led to some gains for the lira, it did not impress the market in any way. On June 14th, Erdogan tightened his rhetoric against the financial markets by threatening to act against the rating agency, Moody's, after the election. This, of course, was a ridiculous statement of no importance, to which the lira responded with another devaluation of a good 1,000 pips. When Erdogan's AKP finally won the elections, and Erdogan had a clear majority in parliament, the lira did not recover either. On the contrary, when he boldly announced that interest rates would soon be falling in Turkey, the devaluation of the lira began to accelerate all the more. Although the euro/Turkish lira continued to move sideways in June and early July, it was stable above 5,500 from mid-July, which encouraged me to buy more positions. Somehow I knew I was on the right path. It was becoming clearer and clearer that it was Erdogan himself who was going to talk his own currency into the ground. I could not have chose a better ally than the Turkish president for my speculation against the lira. And it continued. On July 9th, he appointed his own son-in-law as minister of the new finance ministry. Erdogan empowered himself, through a presidential decree, to appoint the governor of the central bank. By doing so, He definitively abrogated the independence of the central bank, although it was already de facto. I became more and more aware that some people in Ankara were really starting to panic. The more Erdogan seized the course of the monetary policy, the sooner he undermined the meager remaining stability of his currency. On July 24th, the Turkish central bank announced that despite a renewed rise in inflation, it would leave interest rates at 17.75%. This led to a renewed sell-off in the lira, as well as on the Turkish stock market. Everything went according to plan for me, although a real catalyst was still missing in order to catapult the euro/Turkish lira really up. I sensed that it would come. I just did not know from which corner, and I could not have guessed that it would be President Trump who would really get my speculation against the lira going. More specifically, it was not Trump himself, but an American pastor of the Evangelical Presbyterian Church named Andrew Brunson, who would eventually bring me a sizable profit. Brunson moved to Turkey in 1993 and founded a small Church of the Resurrection in Izmir. When he wanted to renew his visa in 2016, he was arrested. He was accused of espionage and support for the banned PKK in Turkey. In 2017, the US demanded the release of the pastor. Erdogan's offer was an exchange. He would release Brunson if the US surrendered Fethullah Gulen to Turkey. Gulen lived in exile in the US and was believed by the Turkish to be responsible for the coup attempt of July 15, 2016. The tug of war between the two countries, surrounding the American pastor, created a tense relationship between the two countries, which eventually led to a veritable diplomatic conflict. On August 9th, Erdogan delivered a speech proclaiming, "If they have their dollars, we have our people, our righteousness, and our God." Hereby, he squandered any hope of economic reform and a monetary policy that did justice to the facts. The reaction of the market was clear. The lira depreciated again, and the euro/Turkish lira rose to 6.15. Looking at the chart, which had gone parabolic in the last few hours and catapulted the gains of my position into the six-figure range, I sensed that the end was near. No one knows in advance where the high will be, just as nobody can predict the low. When the euro/Turkish lira finally shot up like a rocket on August 10th, rising to an incredible 7.83, I started scaling out of my position in the late hours of August 10th, unaware that we were actually seeing the highs in euro/Turkish lira for that moment. Of course, I did not manage to sell at that high again. I was able to get rid of some contracts at a fantastic price of 7.5. Others at a slightly lower price. It was a fabulous profit. Although the euro/Turkish lira rose over 8 the next day, I could only watch it doing so. I was completely out. When euro/Turkish lira fell back below 6.5 in the days after, I was quite satisfied. Perhaps I should have sent thank you cards to the presidents Erdogan and Trump, because it was their play acting that enabled this huge gain for me. Chapter 14. Speculating with stocks. An important question that arises now is whether this method works just as well with stocks. The answer is clear. Yes. There are plenty of examples of traders who have become rich by buying a particular stock and systematically expanding their position as the price of the stock developed in their favor. You do not need to get in at the start of the movement. Of course, each of us would like to have bought Apple in 1998 and then held on until 2019. The likelihood that you will succeed doing it like this is infinitely small. Besides, the question here is not how to become wealthy slowly, but how to grow a small account fast. You can do this if you trade Apple, Amazon, or Facebook for a few months. I would even say that this is an excellent method. So, do not look for some obscure Kazakhstan stock to do it with. Stick to the current market leaders, because then you will be trading with the big funds that do exactly the same thing as you. That this is an excellent method. The question here is not how to become wealthy slowly, but how to grow a small account fast. You can do this if you trade Apple, Amazon, or Facebook for a few months. I would even say that this is an excellent method. So, do not look for some obscure Kazakhstan stock to do it with. Stick to the current market leaders, because then you will be trading with the big funds that do exactly the same thing as you. The likelihood of a trend turning here is much smaller, unless the market's players' perception of a company were to change,
Fellas,
which usually does not happen quickly.
so this thing has been chop, chop, suey. It's been choppy, choppy, choppy. This thing flat, man. You can't play with this. That's how you get hurt. This right here is when people get hurt. Trying to play in this non-trending, no moving market. You gotta wait for the opportunity. And there is no opportunity right now. And, you know, I wish I could be like, hey man, it's a perfect trade right here. It's not. It's not. We gotta wait on it. We gotta see how it works. It's not anything right now to write home about, so to speak. So we have to wait on everything to align, and it doesn't have any push for the last. It looks like to me, I mean, I could be wrong. Let me move everything out of the way and then spread this out a little bit.
I read
All
some.
right. What time is it? 12:48, right? It's been in a range since 11 o'clock. It's literally been in a range since 11:01:18. And it's been in a bad range for the last hour. 507 to 463. So you're talking about like a 43-point range, and it's literally in the middle of that. We gotta chill and wait. Once we chill and wait for a minute, we'll be all right. So yeah, let's do that. All right. I'm back on mute. I just want to let you know that.
With companies that have a good business model. See image 16, Amazon, weekly chart, August 2017 through September 2018. If, for example, at the end of April 2018, after the minor correction, you entered Amazon at a price of USD 1,500 and held out until September, when Amazon finally reached USD 2,000, arrow on the chart. That USD 500 price gain would have been enough to make you a fortune. In addition, you had 4 months to gradually expand your position and trade with the market's money. To better visualize the big market leaders' trends, I like to use the Heiken Ashi chart, especially the weekly chart. As you can see from the example of the Amazon stock, there was hardly any technical correction during this movement from USD 1,500 to USD 2,000. This is typical of stocks that have a large following. Therefore, you should trade exactly these stocks if you want to implement the strategy that I propose in this book. This is where the best chances for success are. On the chart, you can see how the big funds trade stock. Every minimum loss day is an invitation to buy the stock. On a weekly basis, you hardly notice it. The Heiken Ashi charts help you stay in the stock, even if it goes in the other direction for a few days. See image 17, Apple, weekly chart, July 2016 to November 2017. This weekly chart from Apple shows clearly why you should trade the market leaders. The liquidity in these stocks is so big that the chance for random reversals or corrections is very small. If the market players involved in such a phase come up with the idea of selling the stock suddenly, it will be due to clearly bad news from the company or a negative outlook for the next few quarters. That's why it makes sense to trade such a stock from the reporting season to the next reporting season. In between, there are sometimes excellent trend phases that can take several months. As a speculator, you can benefit from these trend phases, so you do not have to buy the stock and hang on to it for years. If you prefer stocks rather than general markets, then you should trade stocks. Of course, you should be aware that stocks are the securities of a company, and companies are run by people who can withhold information from market players. I do not claim that such a scenario cannot happen in the general markets too. The difference is, if you trade an index like the DAX, the CAC 40, the Dow Jones, or the Bovespa, you have no management risk, as you have when trading a single stock. You always have a market risk, and I do not deny that an event such as the flash crash of 2012 could not happen again. That is why I say that you have to write off the money for each specific speculation in advance. However, it seems to me that the risks involved in trading general markets such as stock indices, commodities, or currencies are lower than when trading in individual stocks. There is another reason why I prefer to trade markets rather than stocks. Even though they may have strong trends, if you trade the Alphabets, Apples, and Amazons of this world because they are going up, you are basically doing trend following. You follow the trend in the hope that it will continue for a while. Now, trend following is a legitimate way to earn money on the stock market, but it is usually a slow method. There's nothing wrong with that either. But as we want to grow our small account fast, we are violating the fast rule with trend following. You will have noticed this from the examples of trades that I have carried out. For speculation, I usually choose a market in which some kind of crisis is going on. I favor situations in which something comes to a head. The reason is simple. Such markets are prone to exaggerations, and if I'm well positioned, I usually benefit disproportionately from such situations. That was the case with silver, financial crisis 2008. That was the case with the ruble crisis and the lira crisis. In all such crises, what happens is that the market overreacts. It's usually noticeable that the chart starts to rocket or build a parabolic rise, or starts to fall in the case of a downtrend. And when a chart assumes parabolic shapes, I know that the end is near. Then the time has to come to realize the profits. However, the specific main factor of my method is that the vast majority of profits are realized in the last, and often dramatic, days of the crisis. Why? Because in the weeks and months leading up to it, I have built up my position step by step, and I am fully invested in the moment when the exaggeration really starts and the market overreacts. At that moment, I want to have my biggest position. Of course, if you simply follow the trend, you can also make good profits, but often not as much as you can achieve in the kind of crises I am talking about here. That's why I favor crisis markets, because they promise me the biggest possible profit. That leads me to perhaps the most important reason why I prefer this method when it comes to growing my account fast. This method is designed for people who have a winning mentality and who know how to make the most of the extraordinary opportunities that the stock market offers now and then. This is an attitude that is more about maximizing profits than avoiding loss and risk. If you go to the stock exchange with a mindset of not wanting to lose, you will lose. But if you go with the absolute will to win, then you have good chances of winning. Is it really that simple? Yes, it is. Chapter 15, Trade What You See. As a speculator, you should try to be honest, at least to yourself. If I report some success here, it does not mean that I should not admit my mistakes as well. I have been wrong more often than I have been right. For example, I mentioned that I tried to short the DAX and Dow Jones several times between 2010 and 2012, even though we were clearly in a bull market. Actually, I knew it too well. Looking at the long-term chart, it showed me that the long sideways phase of the years 2000 through 2009 in the Dow Jones was over. And I had a good argument too. If the Fed lowers interest rates to zero, you can barely make any money with bonds. What does a manager of a large fund do in this case? Exactly. He increases his equity quota, because in equities, He can at least earn a return on the dividends. I knew it, and I even publicly proclaimed it at a podium discussion for investors in Brussels. Each speaker was asked to make a forecast for a market. I showed the audience a long-term chart of the Dow Jones on a big screen, and I showed them an upward price projection. Based on my analysis at this conference in 2010, I prophesied a Dow Jones of 20,000 points. The Dow Jones stood at about 10,000 points in 2010. One half of the audience looked at me skeptically. The other half just laughed. I saw my colleagues at the table on the podium shake their heads. The point was, I did not say this in the US, but in Europe. In the US, traders had already been back on the bull train for a while the Europeans were in the midst of the so-called Euro crisis. The media in Europe was full of negative news, and you could feel it in the general mood in the audience at that conference. People were so paralyzed by the negativity that they could not see the obvious opportunities in the US. I was laughed at, and nobody wanted to talk to me after the panel discussion. Who wastes time on a charlatan and a fantasist? Honestly, that did not hurt me much. Much worse was that I did not follow my own convictions with deeds. Instead of just going long in the American stock market and building long-term positions in the biggest bull market in history and making a fortune, I went short multiple times. How can you explain this kind of behavior? How can one act against his own conviction? I have no real answer to this even today. I know that the obvious is often the hardest thing to do. We humans are apparently conditioned to prefer the more complicated path because it seems more logical or plausible to us. Simply buying stocks when they go up in order to sell them a few years later at high profits just seems too simplistic for us. But believe me, most of the wealth in the stock market was made exactly that way, by having people do the obvious. Just as it was obvious to me to short the lira when Erdogan broke his own currency, and just as it was obvious to short the Russian ruble when oil prices dropped dramatically. The obvious, however, does not have a lot of fans. As I learned at the investors conference in Brussels, well, obviously I could not convince them. I did not even believe in my own prophecy. Otherwise, I would not have gone short, contrary to my own conviction. At that moment, one should remind the words of Jesse Livermore, who did his utmost to ignore the opinions and tips of his colleagues, so that they could not tarnish his judgment. If it was hard to accomplish this at the beginning of the century, it is almost a heroic act to keep yourself away from all of that in our completely networked times. Most people seek confirmation for their actions. Is that what I'm doing right now? Maybe there are others who see it exactly the same way as I do. Maybe we can do this together, in a group. I hope the reader can see the absurdity of this idea. Yes, it is uncomfortable to do the opposite of what a whole bunch of investors in a conference hall, who even laugh at you. But that's exactly what you should do. And do not make it unnecessarily difficult. If you have an idea or see an opportunity somewhere, then just buy a small test position. This will show you whether you are right in the market or not. And do not forget the words of the Hungarian speculator, Andrei Kostolany. It's not the news that makes the price, but the price that makes the news. If there is a crisis somewhere, then you can assume that at some point, the negative news will appear, trying to explain it all away. The same is true of the positive news, when something begins to rise dramatically. Chapter 16. How and when should you buy? Some traders will wonder how to go about progressively building a position in a market that is rising or falling dramatically. There is no right or wrong here. If you are right with your assessment, then your position cannot be big enough. We tend to underestimate the factor of position size when speculating, although it is more important than anything else. In my opinion, whether your hit rate is 30%, 50%, or even 70%, only plays a minor role. The question of how big your position is, if you are right, is much more important. As I said before, I do not think it's a drama to lose on your first two attempts. For example, if you lose USD 2,000 twice and make USD 40,000 on your third attempt, In that case, your hit rate is a meager 33.33%, but your average profit is many times higher than your average loss. That's the deciding factor. Therefore, you should always be aware of the reaction of the market when you begin to increase your position. If the market confirms your assumption over and over again, for example, if it keeps rising on a long position, then you should continue buying. If the market does not do that by going sideways or even falling, it is clear that you should rather take a defensive wait and see stance. After all, you do not want to get a margin call from your broker. I admit that I am an aggressive buyer once the market confirms my assumption and my first contracts are in profit. I cannot stress this issue enough. With this method, it's really about learning to massively step in if you're right. The market itself is your best provider of feedback. I hope that I have clarified what this is all about with my examples in this book. Classic risk management does not apply here. You calculate your risk by first testing the water and then stepping in with a small position. Should one work with stop buy orders as soon as the market reaches a certain level? If you like to work with stop buy orders, then do it that way. The fact is that every speculation is different and each has its own dynamics. Sometimes nothing happens for weeks, and then the market shoots up in a few days, as if there is no tomorrow. In such situations, of course, you should have the courage to buy more contracts aggressively within a few hours. On the other hand, there is also the case of a market gradually rising for weeks, like a flight of stairs. Then you have all the time in the world to build up your position, bit by bit. But do not expect it to work that way every time. In general, you will have to expect both ups and downs and reversals. So depending on how many contracts you have already purchased, the fluctuations in your profit loss indicator can be significant. This is an inherent component of this strategy, and you must be able to bear it. This strategy is more of an art than a science. There is no rule that says you should buy a futures contract for every new 100 points gain. For example, if you are long in the Dow Jones future, if you feel comfortable,
Gentlemen.
you should do it that way.
Look,
It looked like we might have something here. I'm still in the range though.
Teasing me now.
Huh?
Teasing me now.
I couldn't hear you.
I said, you're teasing me now.
I mean, to be honest with you, it's just this is how you get hurt, man. This is how you get hurt.
Well, at least I brushed my teeth with my left hand, told myself I love me 10 times in the mirror, and did 25 excessive breaths. So I did do that. So
Yeah. I'm gonna let you know right now, if this thing pop down right here, it's probably gonna go down at 59. Excuse me. At 59, if it gets below 59.75 before it breaks. If it gets to 59 before it breaks, before it gets to 70, it's going down. If it gets to 70 before it gets to 59, not quite yet. Yep. It's tough. This is tough. But I'm telling you, you got a market structure now, right?
mm-hmm.
And everything is, but that 8,100 is up. So, ladies and gentlemen, I haven't taken anything else. I'm just sitting here chilling. This is so incredibly interesting. What I'm going to get you to do, Quentin,
Okay.
is, let me see something. Let me see how Keith's charts are looking. I just know how my charts are looking. Keith's charts don't look like my charts, so never mind.
You want to switch back?
No, that's all right. No, because this thing right here is, we got a stop of 79, a low of 71. Not a low on this bar is 70 even. You had 2 bars to close above.
I feel good about helping.
So this bar finishes red and breaks the low, it's going to go down. I'm telling you that now.
2,700.
No, 900.
Yeah, yeah.
Hmm.
That's just stop is just too big because you got 65 and 80. I can. It's about to come down here. But it is not 100% aligned, so that's why I'm not calling it. But I think from a price standpoint, it's about to head down. We just wait on it.
People get to another level, right? And
I'll go back on mute and wait on it because this is crapola here.
Mhm.
See what I mean by not getting caught up in that bushata?
Yeah.
you can't get up in here and you cannot get up in here and think that this thing is just because it's every time it goes one way, it messes with you and goes the other. Point blank, period. Point blank, period, man. And the killing thing is, it's not even stopped you out yet, but you got to stop at 78. You in at, let's just say 65. It hadn't gone 13 points in your favor, and it's just. I'm not saying it won't work. I'm just saying this is not what you want. This is ideally not what you want to be doing. So we just chill for right now.
Won't ever sell.
Yeah. So, dude, you're really good at your family, your marriage, and prioritizing that, and even
I could be better at that.
we all can.
Yeah.
But even just putting it out there, like opening yourself up, you give back so much to the community. I don't know. It seems like my observation, even from a friend, just straight up friend observation, is that you haven't let the success get to you.
No, I don't think I'm successful yet.
Mm.
You know what I'm saying? So for me, I got this concept. So when I remember, I was telling you I had my continuity program. I went from 10 grand, 11 grand, 12 grand, 13 grand. Then it went to 12, 11, 10, 9, 8, 7, 6. It went all the way down to nothing. And what happened was I stopped doing what I did to get me there. And that's what most people do. You hit a target and you stop doing the thing. So I said, God, if you ever get me back here, I'm gonna always work hard. So I just haven't ever took my foot off the gas since then, keeping that promise. But the second thing is I got a concept called no scoreboard watching. And what no scoreboard watching is, as soon as you hit the shot or hit the game, you got to get right back to work like it never happened. You celebrate for a day.
That's good.
I just say I just finished speaking right on a big stage. ClickFunnels, the biggest stage to date. It was over the next day, bro. I crushed it. It was one of my best speeches ever. But it was next, buy a new house. Next, buy a new car. Next, crush your event. Next, that's just me. It's just ingrained in me. What's next? You should always be looking forward because I can't, 21 was up. Like, I don't want to be a has-been. I don't never want to be, I remember like old heads back in the day, your son, we was out here, we was doing, what you doing today? So I'm just at a spot where, and I don't look at me as successful. I feel like I got a lot more work to do to be successful, but success is all relative, right?
Yeah.
To someone else, I will be successful, but I keep myself. That was garbage. Crowd, they like that joint good. I'm like, that was like a 4. To me, I'm like, that was that was hard. I felt bad about it. All these people coming up, that was the best I ever heard. I'm like, you didn't see nothing yet then for me, because that was garbage for me. But that's what I'm holding myself to. Like, how do we become better? Like, people get too comfortable where they at. I ain't getting comfortable.
That's good. But what would you say is your definition of wealth?
Well, that's a good question. I think, well, if financially,
I think holistically, your holistic definition of it.
holistic.
Hi, my name is Quincy Caver of Good Steward Investments, and I want to tell you or share with you.
Well, holistic meaning not relating it to money?
Just, your all-encompassing idea, like, or I guess another word could be success. Like, if you were to divide it.
Success. I think success is not even money. I think success is being able to do what you want when you want and living life on your terms. That's success to me.
Yeah.
So success is if you yearn to be a doctor and you are now a pediatrician, you loving on kids, you doing what you want to do, you're a family man, like, and that's success to you. That's what success is. Success is, to me, success was when I had my fruit truck. I got fired from 10 jobs and I finally got started. I was making it work for me. I wasn't really making no money. I was still giving back. At the time, that was success for me. So I think success is relative to a person's definition. But for me, it's success is doing what you love. That's what it is. Because I don't do nothing if I don't love it. It ain't even about money. If it's don't,
That's
if
good.
I don't got a joy in it, I will not do it at all.
I love that you say that. That's honestly a theme because I ask that question, often on the podcast, and people are saying it's that. I have been the word that I've been dwelling on is obsession.
Yeah.
If you get paid to do the thing that you're obsessed about,
Right.
it's so natural, and it's when that's why the burnout wouldn't happen. And but dude, that's so good. So much insight, dude.
I actually enjoyed this episode. Not when I say actually, like I wouldn't, but this is one of my favorite. It seemed real relaxed. Like it's not like, a lot of times we go and drop game. Like
Yeah.
it's like I'm teaching, but I felt like I'm giving game, teaching, talking,
Yeah. I think the growth of the podcast is because of the conversational aspect. I actually did a podcast a couple of days ago with a couple guys, and I texted them after and I said, "Hey, you left our conversation to just direct game into the camera, and the reason why the podcast is doing well is because it's just an authentic conversation."
Yeah.
And YouTube can identify that. But I didn't preface it, that.
So you're saying it's better to have not just, all right, guys, let me give you these steps right now.
Yeah, no, don't. And if you're gonna do it, at least don't leave this.
Yeah.
And I think that's probably why you enjoyed it. And I interviewed a guy that I looked up to. His name's Chris Doe. That podcast has like 130,000 views right now.
I've seen him.
And
I saw him speak at, I think, Neil Patel.
oh yeah,
I'm sorry, it took.
yeah. But he even was like, dude,
So I apologize. I didn't even realize I wasn't on mute, guys.
It's okay. We was listening to it. It was good.
Yeah, that's Nehemiah Davis, man, young brother that doing his thing. These young cats out here teaching and stuff. This trade didn't stop you out, but good Lord Jesus, it was tough. He got you in the trade at 65, and then it still ain't went 1-to-1 yet. It's just tough because it's up in you trading in these consolidation moments. You trade in these consolidation moments. Yeah. So ain't a whole lot I can say about this right here. Not a whole lot I can say about this right here. Keith,
What's up?
have you taken any more trades?
No, what trade was it take?
Hey, Keith, can I tell you something real talk, man? Between
Yeah.
everybody, this is just probably between me, you, Keith, and the world. You ready? I mean, me, you, Quentin, and the world. You ready?
Mhm.
Sir, that's growth. Keith said, and I quote verbatim, "No, what trade was that to take?" Like, dude, you talking crazy talk. You talking to me like there was actually something to do. No, man. It wasn't anything to do. It took forever, but the trade actually worked.
And the trade I'm looking for on this one ain't ready. Yeah, anything? Any range?
Huh?
Nah, I didn't see nothing. There was a couple I was looking at, but then something went wrong, something happened. So, I didn't see nothing. There was a couple I was looking at, but then something went wrong, something happened. I have to leave at 1:30 to go pick up Naila.
All right, that's cool, man. We gonna I mean, I'm gonna call it because it's I mean, I'm not gonna get caught up in this mumbo jumbo. It's spread your before you go, spread your chart out for me. Your
8100.
8100. And why can't I see the Zoom anymore? Okay, there it is. I apologize. I mean, what you want me to and do me a favor and take off, just hide all the studies. I'm gonna show you something for a second. Fellas, I don't know what you want me to do with that. The range got worse and worse as the day went on.
Yeah, just kind of move there. Range. Range. Stay in the range.
So when you sign out, Keith, we'll go ahead and sign off. I'll tell you to go do something else. Because right now, this is not productive. Just sitting up here watching this.
Okie dokie.
We've been sitting here waiting on it. And again, it gave you a trade on the 900. Let's just be very clear. It gave you a trade on the 900. It did. But the 8100, I told you I wasn't calling any trades unless everything was lined up. You only had one alignment trade today, and it stopped you out first and then went. And that's tough. So, anywho, I'm just trying to see what this thing looks like here. Yep, nothing to do.
It's time to go. Again, alignment's happening. 7,500 contracts.
Yeah. Until it breaks that low and it's down that near that low, you asking for trouble. You see what I'm talking about? It's right there near low.
Yeah.
What chart you talking about?
The 8100. The 8100. Yep. Yep. All right, Keith, go pick up Naila, man. I'm go do something around the house. I'm not finna because I want to trade so bad. I feel the itch coming on.
Oh,
So when that happens, you know what I need to do, right? Somebody
Yeah.
tell me what I need to do when I get that, because it ain't nothing to do.
that's reason for pause.
Yeah.
Walk away.
Yeah, I'm gonna do more and walk away. I'm finna turn this junk off. All right. Do your thing.
All right.
I'll holler at y'all later on. Y'all will get a real nice text from me a little bit later on. Did y'all get that document I sent?
Yes. It look
Did
nice.
you like it? Give me your feedback on it before you go. That's what I want to talk about. That real quick. Just to say that one more time.
Are you still recording?
I am recording. 1 second. Ladies and gentlemen, we will go ahead and call it a day. Keith was up 9.75. I was up 13 and a half. Done. We're done for the day. So we'll see y'all on the other side. And stay tuned tomorrow. We're gonna have a treat for you if you're on. So we'll talk to you later. Y'all have a good one. But you're right. Let me go ahead and stop this recording. Keith,
Yes.
for whatever reason, I think you're going to have to be the one to stop the record. Hold on, let me do this. Let me reclaim the host. Hold on a second. Once I reclaim the host, and then recordings. All right, ladies and gentlemen, we out of here.